Hello, everyone. All right. Okay. All right. Somehow last time when we recorded, the last 35 minutes wasn't recorded. I don't know whether I just did not really touch this correctly, or due to something else. Just not sure about it. Hopefully, we're gonna get everything correct this time. All right. Do you have any questions about the homework assignment?
Yeah.
Gene?
What do you mean by how big is the company?
Oh, there are several ways of answering that question. You can get like total revenue, total sales, total market capitalization, total amount of asset, things like that.
I was just curious because we already answered those things.
It's what?
Because you asked us those as well, so I didn't know because you asked how much revenue, how much assets.
Oh, okay. Then that might be a little bit competitive, repetitive probably. How big it just can be measured by using, these measurements.
And then on earnings, did you want like net income or retained earnings?
Just net income.
Okay.
Yes.
Is the proper definition for book value, is that your total assets minus your
Book value of total assets.
minus your investor's equity?
If you like the total asset, like the investor's equity, yeah. Book value of asset.
And then on the replacement ratio,
Yes.
did you want like, the definition I saw was, say you discover so much new reserves and then you produce so much.
Right.
That'd be the ratio of what you discover.
Yeah, it's basically change in your reserve divided by production. That's typically defined.
Is it going to be the change in reserve? Or
The change in the
the
reserve.
amount that you actually discovered? Because the change is going to be, so say you went from 100 to 200 and you produced 50, the change would be 100, but you actually discovered 150.
Right. It sometimes depends on how, either one of the ways that would be fine. Just give us some idea about how much of the reserve have changed. Either way would be fine. It sometimes defines it slightly differently. So.
And with that question still, like on EOG, they actually showed how much they produced, and they also had the amount they sold. And they subtracted both of those. So I didn't know, would you want to combine those, or if they actually
Sold you mean the reserve?
Yeah, well, they had like they do like a balance sheet for reserves.
Right.
So they would have like, what they purchased, what they discovered. They call it sales in place and then production.
Right. Okay, I see what I mean.
I didn't know the difference between sales in place and production.
Well, the thing is that essentially, the concept is going to measure, how much of new reserve you actually have in terms of amount of production. That gives you some idea about some additional amount. So if you have the reserve sold, now that's no longer so it should be deducted from the new reserve, newfound reserve.
Okay,
So it
that's
shouldn't be
like
available.
stuff that for contracts and stuff.
Yeah, whatever that is not available, that shouldn't be included in there.
Well, I just did, the one where I took whatever they discovered over whatever they produced.
Yeah, but again, if you look at some of the details there, right? You have some that you said sold reserves. Is that what you said, right?
It says sales in place, and then it says
Sales of what? Sales of.
That's just how they have it listed. So this is like for their oil equivalent. So all their equivalent oil, they showing like a negative 90 million for sales in place, and then a negative 171 million for production. And they're subtracting that from so 2011 said they had 200. And they're subtracting the 90 and 171. EOG. Here. This would have been at the end of 2011 at 2.
Oh, okay.
2000.
Okay.
And then they do revisions.
Yeah. Well, what I would look for is essentially the bottom part here, right? Because whatever that you have here is reflected in the net here. Let me see here. The total here. This is for this year. If you get a reserve from the previous year, that would be the final amount.
You're saying the difference between the 2,000 and 8,000?
Okay.
This is net for 2000.
Yeah, as of 2011. Yeah, yeah. So that's the difference here. The difference should be whatever the change in, because whatever they found, if they don't have that anymore. So if the amount that you found actually is not sufficient to cover the loss of production, obviously that's going to be lost in the reserve. Yeah. The purchase in place, that's the purchase. Okay. Oh, the extent discovery and other additions. Yeah, but the net actually, oh, you actually have a production here. Yeah, I see.
They broke it down
into different parts. Okay, into different parts. So in this case here, you're going to have to look at the reserve and the production, right? Yeah, but if you have the purchase in place, that should be the addition as well, in addition to the discoveries, right? Revision in the previous one. Now that's a quite substantial reduction.
Yeah.
So that just means it's offset the new reserve then. That would be the amount of reserve as well. So this actually has to be subtracted. The production, of course, that has to be taken out in that case.
I just don't understand the way it was defined was
Yeah.
whatever you discover.
Well, whatever you make that available, right? If it's discovered and they have something like the revision, that just means you don't really, essentially, the net of that would be the new reserve.
You would do the change from 1 year to the next?
Yes, the net amount available
And then would I have to divide it
by the
sale?
production amount, production amount. Sales in place, that's the reserve looks like, right?
So there's
Okay,
something-
so you have a purchase, you have sales, you're gonna have to calculate the net. Yeah, because otherwise these are not available anyway. The idea is essentially to see how much new addition you actually have to that reserve.
Because now I'm kind of confused.
Uh-huh.
So I would take the change from 1 year to the next.
Well, in this case here, the change, this is the one you have here, but you have to exclude this, the production from that part. So basically, it's a net change in the reserve. How much net reserve, the increase in reserve, yeah, you should have.
See, I thought that would just be the discoveries.
Well, it's not just the discoveries here, right? Because we have purchased and have sold, which means some of these things are not available anymore. So basically, what we are saying is a new addition from 1 year compared to the other. Did I make myself clear? It's basically the new addition, newly available amount of reserve compared to the production amount.
I'll think about it.
Yeah. It's just like how much more is available now in terms of reserve, right? Because the companies maybe keep finding new reserves, but the thing is then they have a revision downward, which means that they really haven't found that much of new reserve in general in net, which means they did not add much to the new reserve. So the idea is essentially to see how the new reserve, which is additional reserve, compared to the production. You just have to extract some. Yeah, I know, because sometimes when you look at the 10K report, right, or the annual report, there will be lots of information. But what you're going to have to do probably is just turn in some, extract some of these available and relevant information. You don't have to include all the other things. Yeah, say if you have to utilize that reserve table, just cut down the reserve table. Okay, cut down the reserve table. That should be good enough.
What does the standardized,
Standardized measure.
what does that tell us?
Well, that is kind of like the standardized, because in that case that you actually can measure that. Jimmy actually has, is that you or someone else emailed me about the standardized measure? Okay, so David. Yes, standardized, you really have to use the discount value as well. So the company should have that reported.
Yeah, it's reported. I was just wondering what it was for.
Oh, it's basically see how much you actually have You know, in this case, it's just one measure in terms of the total amount available in that case. You know, so discount 10% or whatever, you know, that just one measure of that basically is used for the cross-border comparison. So, yeah. All right, any other things, guys?
When you say changing reserve, like production is also changing the
Also changing production. It's basically the net increase in the reserve. Whatever that is, it could be measured different, right? The net change in the reserve compared to the previous year. And of course, you know, look at the detailed stuff. Then there's a lot of additional items in there. Whatever the net reserve is, net reserve change divided by production amount.
the production amount in the last year, you mean?
You know, over that. Suppose we are looking at 2012, right? So the production should be the production amount in 2012. Right? Okay. Now, yeah, I wouldn't be so picky about what you're going to do. Basically, it's like reflecting the changes in reserve. You know, if you can get the right information, the purpose of that is just for you guys to go through these things, just get some idea about what they have there, what kind of information they have from the 10K report or an annual report. That's the purpose. I mean, there are a lot of detailed stuff, right? If you can get that straightened out, that'd be fine. You know, if there's a little bit of things here or there, you know, I don't think that would be a really big deal. Okay.
What's the meaning of the extraordinary items?
Extraordinary items that a lot of times that a company actually would have something occurring maybe just only once. You know, not the regular kind of event would happen. I mean, typically, if the company actually has a loss due to some kind of accident or storm, whatever, that's going to be reflected on the income statement. So sometimes you're going to be able to see that from the income statement. If they don't have any extraordinary items, then you would not be able to observe anything from that. It could be equal to zero.
Like if you don't want to have to look through all of it, Yahoo will list it as zero.
You have to list the zero, then just a zero. There's nothing there.
You go to like balance sheet or cash flow on Yahoo,
Yeah.
most of the answers will be there.
Yeah. Just look at the, and that's the one way of getting it, right?
I went through the 10K, but then I went through the Yahoo just to make sure everything
Right.
matched. Theirs is a lot more concise.
And the 10K or annual report has so much information in there. Sometimes can get confused. You know?
130 pages.
Yeah.
I was between the Yahoo Finance and the company report is that there was a difference in the number of shares of stock. One said 2.5 billion and one said 2.2 billion.
Is at the same time? You know, they probably picked it from a different time.
It's possible that the one from the Yahoo Finance was this year,
Okay,
and they probably issued more stock.
it's possible. Yeah, because if you look at the annual report or the 10K, that's as of the end of the previous year. So the timing may be different. That might explain, you know, as you said, that they may have issued new stocks. That could be, or have repurchased, right? Some of the stocks. So that may cause that to change. Yeah. I mean, Yahoo Finance certainly is one good source of the information. There are a lot of other things out there on the internet. I mean, the official one, of course, usually we just go to a 10K or the reports. Okay. Okay. Any other questions, guys? All right. Okay. If not, then we're gonna continue. And I was looking at the schedule, or I mean the remaining weeks we have. We really don't have that many, and we don't have a whole lot of topics either. But we'll see. Okay, we'll see what we can do. And after this, we're going to go into the valuation of specific assets in the oil and gas sector. And the final topic will be the valuation of bonds. And I think we have 5 or 6, maybe 7 more topics, right, left for this semester. Okay. This is the one that we actually kind of stopped at. Well, actually didn't go over this, right? basically what we were talking about at that time was about the return on the asset or the return on the equity, ROE and ROA. And we just made up a few numbers there. Okay, so the example is assume two companies, X and Y have two companies, and both earn 50% rate of return after tax in investment capital. I mean, it's just some of the assumptions about after tax. There's no particular reason why it's after tax. There's no reason. We just try to come up with some numbers there, all right? Both can borrow 10% interest rate, and then X borrows 50% of capital, and Y doesn't borrow any of these. It's all equity financing, right? So what we want to see here is, oh, what's the kind of difference that's going to make on the return on equity and return on asset, okay? So it's kind of obvious, I suppose, okay? So if we look at this here, right, for the company X, we actually have investment capital and the borrowed capital. Total amount equals to 1,000, right, $1,000 million or whatever. And then here we have a company Y. It doesn't have any debt financing, so it's total 1,000. Now this amount here, after tax return, before interest expense. Now we said this is due to the assumption, right? Both of these are 15%. So that's why we have 150 for both companies here, okay? Then after tax expense, because one of the things that we have here, I put down a little bit of note here, right? After tax interest expense is equal to the total interest, which is 50 million, right? 50 million. Total interest of 10% on the Y500 borrowed capital, according to our assumption, is 10% of 500 million, right? So we have 50 million, so that is the total interest. But actually the company is not, the tax amount, right? Tax expense amount has to be taken out. That's why we actually have to take out $17 million, and then that would give us the after-tax interest expense, the 33. So this is actually pretty small to see that, right? So we actually have an interest expense of 33 because the 17 is due to the tax, right? Due to the tax, that wouldn't really consider as expense. And then so the after-tax return with after-tax interest. So the return actually with that interest is about 117, right? 117. Basically just 150 minus 33. And then for the company Y, it's 150. So we're going to use that to calculate our, with the interest expense deducted. So we're going to use that as the net income, right? And then calculate the return on equity and the return on asset. Basically, we have the different numerators. The numerator here is 117, here is 150. But then the base numbers are not the same. The equity amount for company X is 500. For company Y is actually much lower. Is much larger, right? The $1,000. So obviously, the return on equity would be really not the same. Will not really be the same. Return on asset would not be the same, right? Return on the asset would be 117 divided by the total amount of asset we have, right? Is 1,000. So that's about 11.7%. Here, return on assets is going to be 15%. So the return on assets is going to be higher. Why return on assets is higher is because of the interest expense, right? The interest expense in this case. So you don't have to pay any kind of interest on taxes. So return on equity would be different because this one here, because you have a smaller amount of asset, the equity. In that case, then the return on equity actually is going to be higher, all right? It's going to be higher at 23.4%, but the return on equity for this company, company Y, is only at 15%. Now, one of the issues, of course, is, hey, which one is going to be better? Sometimes we're going to ask that kind of question, right? Which one's going to be better? It looks like return on asset actually is pretty high, right? But to an investor, what we look at is what? The investors look at return on equity, right? They don't necessarily look at a return on assets. So they look at a return on equity because I made the investment of $500 million, and then what is the return on that amount of investment? Well, according to this, actually, this is going to be a little higher, right? A little higher, 23.4%. I guess what we are saying here is that these ratios actually is going to tell us some kind of different stories. It really depends on the capital structure of the company, and also because of the tax implication on the interest payment. That will make some differences, right? That will make some differences on all these numbers. So what's the bottom line? Bottom line is we really have to look at the details of the company financial situations and make some judgment about the profitability of the company and the returns on different things. I think that's just a few things from the last time, right? So I think we went over the other ones, even though I did not go through very much in detail. But I think these things should be fairly straightforward. How to calculate some of these ratios, right? Some of the ratios. I mean, what we may have to do is to be able to calculate a few ratios, have some kind of interpretation. I'm still thinking about, what would be kind of questions that I may ask on the final exam, because I think that's some kind of question you guys might have in your mind as well, right? I might give just a few numbers there. What you're going to have to do is just calculate a few ratios and interpret a little bit about what that means. Okay, what do you see from these ratios, right? So as far as this part is concerned. Okay, some of the ratios there should be fairly straightforward. Okay, I'm going to move on to the other one. I also put on D2L a couple of other things. One of these is so-called the recent trend in oil and gas sector. So this is the one. I'm not going to go through all of them, right? So you guys might just have a kind of quick look. Okay, quick look over some of these things here. So basically, this is a little bit outdated, but I think this probably is more of one of the latest information on the oil and gas industry performances. Okay, so just look at, they provide consolidated income or financial statements for the whole oil and gas industry, including the refining sector as well. So the cash flows and all these things. Let's look at a few diagrams there, okay? Just look at a few diagrams. All right, so this is the one here, a chart. It says the FRS, financial reporting system, all right? Basically, net income. This actually indicates the profitability of what? Of the oil and gas and mostly it's the oil and gas companies, right? The refining companies as well. And you can see there, the largest amount of the income, so very profitable. But during that time period, 2004 through 2007, okay, this period here, 2007, 2008. But then in more recent, of course, we don't really see any of these things here, right? The profitability of the companies declined a little bit, but most of the profits actually occurred in this region here, okay, in those years. Now, why is that? Why we actually see such a spike, okay, increase in the net income or profitability of the oil and gas companies? The major reason actually is, well, property and gas, right? Is what? Is the
Fracking.
huh?
Fracking, but it started in 2007.
Which one started in
I was going to
2007?
say fracking, but it did
Fracking. Fracking actually started a little bit early, though. 2007 may have a substantial impact. Just has a huge increase in production. The production certainly increased quite significantly. Production in that case, fracking, oil and gas. That could be one part of that reasons. There's another reason. I think that's probably more important than that, than the increase in the production amount of the companies. Yeah, I was looking at something else though. There's one thing, one factor will probably, it could be in our mind, maybe thinking about it. How about oil price? Right? Oil and gas price, especially for the oil and gas companies, that seems to be a more important factor. As a matter of fact, if you look at that, right, the oil and gas price during that year, just been increasing all the time. But then getting into 2008, the prices drop. This is the reason why. What is the point? The point is that the oil and gas companies, right, depends on their bottom line, depends on the price of the product substantially. That is more important than the increase in the production. And the fracking actually, started a lot more in the 2000, basically, right? Especially the proliferation of the production occurred like 2005, 2006. So Jim's actually is right, absolutely right. I mean, just has substantially increased production line. But the more important factor is the oil and gas price. Okay, oil and gas price had a lot of impact on the company's bottom line. Return on equity, and there's a comparison here. So we talk about return on stockholders' equity here, right? The blue line is the oil and gas companies, and then the red line is the manufacturing companies. Clearly, this period here, right? This period here, people were talking about a big oil, making so much money, and on top of everything, it's related to the oil price. So I'm not going to go over every one of those, just kind of quickly, okay? Sort of go through this. Investment, this is the return on the investment. Okay. If we don't look at that, net investment. What I mean by return on net investment, the investment includes what? Not just the equities, right? But also there are some debt financed investment. So that return should be a little bit lower than just return on the equities, okay? Because the return on debt usually is a bit lower, all right?
Sorry, repeat that.
Return on investment.
It includes debt and financing?
Well, basically the investment amount, right? If you look at the investment, that this is basically total capital, right? So it includes the debt financed. So it's not just return on the equity, but also include the return on the debt. Okay, let's see here what we have here. Capital expenditure. I was hoping to see the. Capital expenditure. 2 years we really can't see much about it. So we need to look at the more. What is this in here? Yeah, this is actually something I was looking for. Okay. This is kind of investment in the oil and gas industry, right? People were talking about, like the waves in making investments in the oil and gas industry. Right? There are two kind of things here. One, of course, the red bar here. The red bar indicates the merger and acquisition. Okay, merger acquisition. In some of the years, actually, the merger and acquisition seems to be pretty big. Okay, pretty big amount. Right? And then the other ones, of course, is other additions too, right? So it's not necessarily merger and acquisition, it's just net investment. Of course, here we have substantial increase. This is understandable. Why? Because company has just a lot of cash, right? A lot of cash. Obviously, they can make a huge amount of investment. As the price is high, they make a lot of profit, so they're gonna have a lot of cash in hand. They're gonna do that. And the mergers, right? Merger. Later on, we're gonna talk about a merger and acquisition in the oil and gas industry in the later chapters. Okay, we're going to talk about that. Mergers tend to occur in waves, right? Sometimes we actually see things like that. Yeah, this is the total amount, merger and acquisition. And some years, this is actually tend to be pretty low. Some years actually tend to be pretty high. All right. If you look at in a relatively longer time horizon, and you could see this. If you fit some kind of mathematical model into that, you sometimes can actually explain that. You can explain that. Actually, I had a paper more than 10 years ago. Okay, more than 10 years ago. Not look at the oil and gas industry, but look at the overall merger and acquisition in the industries, and basically to fit some kind of mathematical models into that, and then estimate that. Pretty much like you can essentially use those kind of curve to fit that. But there are some explanations for sometimes why we actually see a larger amount of merger and acquisition. There are some reasons. When we get to that part we're going to mention that. We're going to sort of have a kind of brief discussion on the mergers and acquisitions. Okay, I think that's pretty much. I don't want to say a whole lot. E&P expenditure, cash flow operations, E&P expenditure. This actually tells us a lot of these things about the financial situation, production amount, reserves, and everything. So it has very interesting information on the overall conditions of the oil and gas market industry in the U.S. So I'm going to go through that. You guys can actually look through this and then find some kind of general trends, right? and also the oil and natural gas lifting cost. It's kind of interesting to see how much it actually costs to produce the oil and gas from underground. And also we actually have E&P, I believe, some kind of finding costs. We have some finding costs as well. You can see the finding costs increased substantially in more recent years, right? Finding costs. It used to be pretty low, right? But then all of a sudden, the finding costs increased to $40, $6 a barrel. And this actually is kind of important because if we try to see what would be the minimum amount of the oil price we're going to see, right? What kind of price we're going to see? It depends on the cost. Of course, sometimes people say, well, the oil price doesn't really depend on just the cost of production as well as the cost of the exploration, okay? And there are some kind of resource costs included in the price of oil and gas. But these provide some kind of foundations for pricing the oil and gas. Right, so $60, $70. So what is actually the cost of the oil and gas? I mean, we're not counting the profits. $100, $80, $90, roughly. I mean, according to this, right? This area here, you could have like $40, $50. And then the lifting cost I think is about $10 or something. This is the lifting cost, okay, on average. So basically, according to this, the cost is roughly about $50 to $60, right? It's $50 to $60 according to that. This is on average. For some companies, the cost actually could be a lot lower, right? Or some companies maybe a lot higher, right? $50, $60, plus the transportation and all these things. And the oil price, $90. Obviously, that's very profitable for the oil companies, right? For the oil companies. And this is also why, if you look at OPEC, they're not really talking about, just control their production, right? Raise the price, raise the oil price. They're not doing that because the oil price is high enough, right? They make enough money already, so they really don't worry about the oil price at this point. All right, so I guess I'm going to stop here. I'm not going to go any further. So you might want to just look through casually and find out something.
Are there going to be any of these graphs that you're going to refer to in the final exam?
Probably not. This actually gives you some basic idea about the general trend in the oil and gas industry. I know that if I said that, you're not going to look at that probably, right? You're probably not going to look at that. But anyway, if you want to find some information, I mean, here it is. Maybe I should just assign a homework based on those, so you guys gotta read that. You're not going to test you on those. And this one here, I actually put in one sheet of paper. I think this is kind of interesting, it's relevant. I copied from one book, and I forgot which book. Okay, so the source, Reuters, right? This is from that, and they actually, the book actually copied from that Reuters, right? investorreuters.com. That's for September 2003, and actually you can look at that. What the kind of a comparable ratios we actually have for the oil and gas industries, right? So you actually have integrated oil and gas companies. So this is actually for the large oil and gas companies, okay, large international oil companies. And then you got equipment and services here, and E&P companies here, drilling, and then refining, and the marketing. You have different industry sectors here. Okay, and also we have look at the beta, PE ratio, some of these ratios, valuation ratios, right? And then the dividend kind of thing, dividend yield, and all these growth rates, sales, and some of the quick ratios. That gives you some idea about what the typical company financial ratings look like, right? So still it's a good reference, even though it's like about 10 years ago, right? The information seems to be kind of outdated 10 years ago. But the industry hasn't really changed that much, right, in terms of the financial ratios. And some of the ratios are still pretty much the same, right? Still pretty much the same. Okay, I didn't really try to look for any kind of new information related to that, but I believe it's pretty much the same. By the way, if you want to find the information about the industry, right, there are a lot of sources there, right? You just have to compile them, right? For example, like financejapa.com, they have things like that. If you want to look at the other things, you also have some other analysts, right? They actually, just website, they provide the general valuation ratios for different industries, right? Sometimes if you look at one company, they can actually have information listed for the whole industry, so you can actually see how this company compares to the industry. Like, you know, the same, you know, they have all this information. They just have to spend time sort of searching for it. Okay, right. This case here, some analysts or reporters actually compiled all these things and then put it up there. All right, so I have that loaded onto D2L. Okay, D2L. And I'd like to get started. You guys have any questions or comments? No, don't bother. It's fine. Okay, anyway, so let's just get to the next topic, valuation of the stocks. All right. No, so actually, this unit actually covers the most basic and you know, kind of interesting topics about the stock market and the stock market valuation. So I want to go through some of the basic stuff. Okay, I know some, you know, you guys are already familiar with some of these things, but not probably to everyone. Okay, so I like to go through just little details. If you have any questions, let me know. And for some of the parts, I might just have to go over that kind of quickly. Is the radio still on? The microphone is still on, right? Okay, somehow, maybe it's because of my ear. Just all of a sudden. All right, so I'm going to go over the stock and the stock market, some of the basic concepts. Then market values, book values, and liquidation values, so how we define that. Okay. Now, the reason why I'm doing this is because sometimes you're going to have to evaluate companies, you know, stocks, stuff like that. You know, what we're going to look at. All right, so we have to have some kind of general idea about the things we use. Okay, how are we going to be able to value common stocks? What are some of the general methods that we use to value common stocks? So we're going to go over that. And you know, we're going to have so-called a dividend discount model, right? We use that to value the common stocks and simplify that. All right, what's another one? What happens if we have growth stocks and income stocks? How do we evaluate that? And there will be some calculations, and of course on the exam, I'm going to ask some questions related to those calculations. So, you know, how we're going to be able to evaluate these kind of stocks in general, right? So, all right, next one then is there's no free lunch on Wall Street. This is something we're going to get to that, all right? So this is related to some of the anomalies, okay? Anomalies, like, you know, the next topic is market anomalies and behavioral finance. This is kind of interesting. Last time when I was talking about the guys who won the Nobel Prize, right? I mentioned some of these things about what Eugene Fama did and what some of these is the Robert Shiller did, right? So, and market anomalies, the behavioral finance, this is related to mostly the work of Robert Shiller, not Fama, Eugene Fama. Right? Why? Because Eugene Fama is the one who promotes the, we know that, efficient market hypothesis. This is from Chicago, right? Okay, so it's basically, you know, the market is very efficient in processing information. So it's kind of interesting. Think about this, right? These two people, they actually kind of hold different opinions regarding the stock market. Because Eugene Fama is a proponent of efficient markets hypothesis, but then the Robert Shiller says, well, you know, it's not really actually true. And there's another guy who is also from University of Chicago. He is on the same boat as Robert Shiller. Basically, they argue, well, there are some anomalies that defines explanations of the efficient market hypothesis. Right? So the market may not be so efficient. And this is why we're going to look at some of these market anomalies. And you know, behavioral finance is being used to explain some of these market anomalies. So we're going to look at that. Okay, we're going to look at some of these things. All right, and then we're going to look at you know, some of the things regarding the OMG and the oil and gas industries. Right. So that's the general outline for this particular thing. So let's just go through the some of the basic concepts. Okay, basic concepts. When a primary market, primary versus the secondary market. Okay, so we have several things here, right? The primary market is for the sale of new securities, right? So when you have an IPO, initial public offering, that's offered in the primary market. But what's the secondary market? The second market is a place where each of us trade, right? Basically, you know, we now own some of the stocks, then the holders of the stocks actually will trade with each other on the secondary market, not the primary market. So the primary market is related to the IPOs, all right? So the seasoned issue refers to the sales of new issues by a firm that has already been through the IPO. James was talking about the number of shares outstanding to be different from, obviously, that could be a seasoned issue in that case, using that kind of definition. Right? So these are some basic terms. So this is a stock certificate, right? This is how I just randomly chose one stock certificate. I did not want to put my stock certificate and print it there. I mean, the stock, I have some of the stocks. Nowadays, you don't have that, right? Usually, when you buy a stock from the secondary market, you don't have the stock certificate, right? Nobody's going to send you the stock certificate. So if you have original issue stuff like that, then you actually have some stock certificate, right? Some kind of certificate, right? So this represents 200 shares, right? How much is the face value? The par value? Try to see here. Okay, it should be somewhere. They usually will indicate, indicate the total amount. 200, 200.
40 cents, it
40
says,
cents.
right in the very center above Air America.
Oh, okay, let's see here. That's about 10 by. Oh, yeah, the little thing. I was trying to look for that. You guys just have very good eyesight, obviously. I couldn't even see that at 40 cents each of the capital stock. It's only 4 cents. Actually, on my stock certificate, it's 1 cent per issue, right? Per issue. Oh, I should say per stock. So just that face value doesn't mean anything, basically, right? All right. Okay. Oh, I already have that. Common stocks is ownership shares in a publicly held company. And secondary market, we already just said that, right? Dividend, we know what that is. The PE ratio, we know what that is. All right. Oh, okay. So this is what we are saying is that how do we evaluate that? The difference between firm's actual market value and the liquidation book value. So we have a book value. The difference is what we call the going concern value. What is going concern value? Why we actually have going concern value? Because you can earn extra income, right? Because it's not just whatever the liquidation value, whatever the value of the asset is, right? You actually can generate future income. That's one. Intangible assets, so it goes beyond the tangible assets, right? So the firm actually has a value in terms of intangible assets. The value of the future investment, we don't have that yet, but there's a possibility of investment in the future. Therefore, that's being counted into the stock market valuation of the company. All right. Yeah.
Talking about book value, is that total assets minus liability, minus intangible assets, goodwill, preferred stock?
Well, the book value is the value of your asset minus the initial value of your asset. I shouldn't say initial value. Is however you paid for at the very beginning minus depreciation.
But you don't, but when we're like for the homework,
Yes.
you don't know how much they paid for in the beginning, right? Or
Well,
you just
the book value, yeah, you don't know that.
Yeah.
You don't know that. But the thing is that from their balance sheets, they should have that. Should have the book value of the asset.
No, well, no, it doesn't.
Wouldn't you take the total assets minus your equities value?
You take the total, what, total what?
The total asset value minus the shareholder equity, because you can't just take that money away from shareholders. So you're gonna have what everything's worth, and then you have basically what you put into it is whatever the equity of the shareholder
Right.
is. So you take that away from that, the value of the company is gonna be what's left over.
Right.
You say minus shareholders' equity, but then other, like Investopedia says it's minus liabilities. So,
Yeah,
what's the right?
you look at the balance sheet, right? If you look at the balance sheet, you have what? You have on one side you have assets, okay? On the other side you have liabilities, right? You have that, okay? asset liabilities. On this side, you actually have the shareholders' equity, right? The asset is on the one side. That's the asset there. That's the book value of the asset, the company asset.
What? I don't understand that.
You have a short-term asset. You have long-term asset, basically, right, on the balance sheet.
So which one are we looking at for book value?
If you look at the book value of an asset, it should include everything. It should include the asset on that one side. That's the book value of an asset.
So we just want the total value of the asset.
Total value of the
But
asset.
they take away depreciation from it.
Well, this is already taken away. The depreciation is already taken away
So
from
we
that.
just take total assets.
Yes, this is total asset.
But
Because
then we can easily say that that's what the company is worth.
Yes.
So that's the same thing.
that's the
as
same
book
thing.
value.
That's the same thing. Yes. Because a lot of times you look at the think about the original price you paid, right? We don't know because so many years you actually have a lot of different items there, So whatever that reflected on that on that book is the book value. It's not the market valuation of the asset, though, right? It's just book value.
It's the book value per share, and when I did the book value per share times shares, I got the same value as taking the total assets
Minus the shareholders. Is total what minus shareholders? Is total liability
I
minus?
had 27 million in total assets,
Okay. 27 million total asset.
13 million in equity for the shareholders. which is
Okay.
14. And if I took the book value per share that Galaxy gave times the amount of shares, I got
14
billion.
14 what? Billion of what is the
Book value.
book value?
So what about the definition?
Book value. Book value what? Book value of the company. What we are talking about here is what? Your question is about the book value of the company, book value of an asset. What you're talking about, the probably book value of a company is the net worth of the company, right? Yeah. I think in that case, we're talking about the book value of an asset.
No, I'm just asking about book
Book
value.
value. Book value could be book value of a lot of different
Of the
things.
company.
Yeah, if you look at the book value of the company, if you look at that, how much the company is worth has to be between the difference between the asset and liabilities. That's the net worth. I think this is basically what you just calculated.
I'm just saying.
Yeah, I was thinking about the book value of the total asset to answer your question in that case. So in that case, you take the asset on one side, right? Whatever that is the book value. But if you talk
Same
about
value. Still 14.
asset and the liabilities, asset and the net worth may not really be the same, right? Because you have to have a total amount of asset, which is equal to say 10 million, right? But you have a liability of a certain amount. So the net worth actually may be lower than the net asset amount. Is that right? Net worth is the owner's equity part, basically. How much the company worth. Right?
I'm done.
Look at the book value. Book value, which thing we're talking about, basically. This is something we need. So in that case, we're talking about different things. What I was thinking about is different from what you were thinking at that point.
The way I understand book value is if I were going to sell a company today, this is what it's worth. You have everything that's into it, which would be at one value, but you have to give equity back to whoever owns it. So the book value is going to be everything is worth minus whatever's put into it. That's what it's going to be.
But if you do assets minus stockholders' equity, isn't that just your liability?
That's a liability.
And that's not worth anything.
I can
for them.
show you my balance sheet later when we go over it, and they have everything listed out.
Okay. Yeah, I'm gonna look at that during the break and look at that. But generally speaking, that's what it is. Depends on the book value, whichever we're talking about. In this case here, actual market value and its liquidation of book value. The liquidation of the book value is attributed to. In this case here the liquidation book value is actually how much it actually worth of the asset in that case. In terms of just literally looking at that, right? So if you look at the total book value of the asset, it's whatever is on the book,
Sorry.
on the balance sheet.
Can you just explain this? Because what I got I searched online for this
Uh-huh.
from different sources, but Investopedia is pretty good for
Right.
definitions. And it says book value of the company is total assets minus liability, goodwill, intangible assets, and preferred stock.
Okay, they're talking about not the company's asset, they're talking about the net worth of the company.
So
basically.
that is, but would that give you the same answer as just doing assets minus liability? That's kind of different, because you're still including intangible assets, preferred stock, and goodwill, right?
Intangible, it took out the intangible asset. Is that what you're saying?
Yes, it took out intangible assets, liabilities, goodwill, and preferred stock. Why is that?
Okay,
Why is
there
that
are-
different from?
They are looking at just the physical asset in that case.
So when you asked us to find that in the homework,
Mm-hmm.
what do you want?
Okay, you just say as long as you gave me the definition of that, that's fine. You know, as I said, the purpose of that, because a lot of times when you look at these things, right, the definition may be a little different. Okay,
So if I use that definition.
if you use that definition, that'd be fine. I mean, think about this. Not everything is just always consistent with each other, by the way.
Right, but
Okay.
when you're learning it, I mean, you kind of have to have some kind of standard. because
Right.
That's the net book value.
Net book value.
There's two definitions. You read that one, you read that's net book value. You read the one below it, that's book value.
What's the one below? That's the current, the assets minus liability is the one below it, right?
No,
What does it say?
what I've been saying.
Oh.
Okay, I need to
Two
look at it.
definitions there. She's reading the net book value and
Uh-huh.
went with the one below, which is book value.
You know, to us, one of the things that that I did not specify that very detail is that we're not accountant for one thing, right? As long as we understand the basic concepts and relationship, that's good enough. That's just as I see that. All right. So
My basic
when
understanding
the
is-
thing is that if you look at the very much details of the company, financials, statements, stuff like that, you can get hung up on a lot of detailed stuff. I totally agree. I'm gonna look at some of these things during the break, okay, and see, okay, all right. Book value, according to this, is net worth of firm according to the balance sheets, right? So this is a typical, I'm also smiling about that, and it is it's just the net worth of the company, basically, right? According to that. Now there could be a lot of little line items there. All right, so the liquidation value, as we said, is net proceeds that could be realized by selling the firm's asset and paying off its if creditors. So you can see here that liquidation value has nothing to do to take into consideration of those three factors we talked about, right? The going concern value, because we don't have any future value generated from that. All right, the market value balance sheets, and we have to use market value of all assets and liabilities, which could be different from the liquidation value. It's just theories. I put something there because Dave Ramsey's caller. I remember one day, and there's one caller actually called up Dave Ramsey on that talk show, and was asking him whether she should pay this much for that kind of business that she would like to have, because she was interested in having a floor business. Okay, basically it'd be a floor and then sell flowers, stuff like arrangement, stuff like that. And then Dave Ramsey was asking her, should you pay this much or not? And she was asking Dave Ramsey whether she should pay the $20,000 for that business. Okay, Dave Ramsey was asking her a bunch of questions in order to clarify the answer. One of the things was that, hey, why is this person selling it? Okay, this is important. Why? Because if the person is selling it because the person is not making money, right? Okay, now that business wouldn't be worth that much. Basically, the business probably just worth the value of this thing here, right? Just worth the book value. That's how much that whatever these kind of assets that the store has, that's the worth of it. So if you just add up all these, it's maybe just equal to probably $5,000, right? But if the business is making money, therefore, the assumption is what? The assumption is not the liquidation value in that case, right? So we have to look at the store from the perspective of a going concern. Therefore, that price should actually be a lot higher than the book value of the business. So that's the point we try to make here, right? The point is that whichever the type of the business we have determines the valuation approach. All right, so the valuation method we have, generally we have several of these, okay? One is the valuation by comparables. Look at the ratios and the multiples, and what we're gonna get there, what I mean by that, ratios and multiples, right? Look at the book value sometimes, you know, for the end, without getting into too much of details. You look at the book values here, some of the ratios, right? And then sometimes the valuation of the company will be a multiples of the book value. So if you look at the book value of the company, maybe $2 billion, right? But typically, this kind of company, if you use the multiples, then roughly, if the multiple is like 2.3, okay, so the company value should be a $2 million of book value multiplied by 2.3. But a lot of times you're going to say, well, I'm going to get into the details of everything, right? Try to calculate the value of this, value of that, value of that, and add them up. And sometimes, you know, they don't really look at that. Or sometimes they just look at the overall value. You already have a book value, but then what we are doing is, basically, for the past year or so, company has been selling at the 3 times of the book value. Then what they can do is use the same multiple here, right? Say, because we have been selling the company using the multiple for 3. In this case here, I might just use the same multiple to evaluate your business, right? In that case, if we're talking about $2 million of book value, the multiple is 3, then the company would be equal to, be worth $6 million, right? So this is basically what we're talking about as the multiples, the valuation approach. That seems to be fairly straightforward, right? Okay, but that's what it is. I mean, it's kind of simple. But what can you do about this? Because a lot of times when you are looking at the actual valuation, the market value, how can we really understand the market value? But the market value changes, right? Changes according to the market conditions, changes according to the price of oil and gas, right? So all these factors change. So they really don't have a particular value for a particular line of business. It depends on a lot of different things.
So you're saying multiples, just to make sure I understand, is like basically the market cap of the company and what that is compared to what their book value.
The book value, you can say that, I mean, especially in the past. But again, the market value may not reflect the true value of it, right? So you know, you can use the market value, stock price in that case. You can do that. But sometimes the company's stock price might be too low, right? Undervalued, could be overvalued. And then it depends on the investors. The investor believe that it's undervalued. I don't really care about the market value. So I'm going to simply use the other multiple to do that. It's very subjective in that case, right? Very subjective. Okay? But again, I mean, on the valuation of the asset, it's just like a kind of subjective in that case, right? Since objective, subjective, right? Because things change all the time. And then, you know, how do we know this is actually equal to this value? The replacement value may not really be the same thing as the value of the business, right? So you really cannot use the replacement value to evaluate a particular business, right? So it's different. Right? So we actually have several ways of doing that. Price intrinsic values, and then we talk about essentially this is what I meant. The price may not reflect the intrinsic value of the business, right? I think we'll probably have details there. I've cut about. Okay, and then the dividend discount model. So we're going to use the formal model to see how we actually can evaluate these. All right, so we can calculate the expected return from this, and then we can find out what the of the price of the company or the business. Right? Expected return is something we have studied before, right? We said the expected return equals to 2 parts. Right? One is a dividend yield, right? Dividend divided by that. Another one, the second part here is what? The price appreciation, right? Appreciation, okay, is capital gain, basically. This particular case here is a capital gain. So there are 2 parts here. So sometimes we call it the holding period return, holding period return. So this is the part we just said. The formula can be broken into 2 parts, dividend yield and capital appreciation. So there's 2 parts here. We have seen that before. So what we can do is essentially use this particular, one of the things we can do here is that kind of similar to what we had before, right? Essentially, what we are looking for is essentially what the price of P0 here is. Okay, what the P0 is. And it depends on, if you manipulate the formula or whatever, it's going to depend on the dividend, right? Dividend, right? Depend on dividend and all that things. So the dividend discount model is based on that kind of idea, okay? Based on idea. That is, the price actually should reflect the earning, the ability of the business or company, right? The present value of all expected future dividends, right? How much it's going to bring to you, then that should be worth of the company. Then this is what we have. It's pretty straightforward, right? So the price of the company should be equal to the dividend over here divided by discount, right? Towards the last part here, the H is what we call the holding time horizon. And then if you hold it for 10 years, okay, if you assume this to be equal to infinity, then the price will be a little different, okay? If we, and then H period, hold H period. So this actually is the remainder or the remaining value of the business, right? If you don't have that, as we said before, this could be the salvage value of the company, right? So you just calculate all these that give you the price of the stocks, okay, price of the stock. Just very straightforward. All right, so we actually have a very straightforward example here. Okay, so we have a company, and the company pays a dividend of $3, $3.24, $3.50 for the next 3 years. At the end of the 3 years, we expect to sell the stock for $94.48. Okay, what is the price of stock? I mean, that's kind of straightforward to calculate. So what we're going to have to do is discount the dividends, right, as well as the selling price at the end of 3 years, and then we come up with $75, right? $75. So stock price should worth $75.
Is that how you choose? Is that how you would judge something to be undervalued or overvalued if you had those sorts of projections?
Yeah, one of the things we do have that. There are several factors there. One of the factors is the dividend here, right? The dividend, this is based on what we consider as the possible dividend. But again, sometimes we believe that the business situation is a lot better. The dividend growth rate is not going to be equal to this. It's going to be more than this. So you actually have the dividend growth rate in your mind, which may be different from the market. If you believe the dividend growth rate is higher than what market perceives, then you would believe that is actually undervalued stock because the market is paying the lower one price, right? You believe the price should be a lot higher. Yeah, this could be one thing. Again, this could also be one part of it. But a lot of times there are some other reasons, especially when we are saying that the one company is undervalued, right? There could be a lot of other different reasons, okay? Not just the expected dividend amount, right? Because the operating conditions that people perceive to be different. Maybe this kind here, that the demand for this kind of case, for this particular product actually, has been depressed due to whatever the reason, right? And then it's not doing good, and the company is restrained by the cash flow problems, things like that. And so nobody actually is willing to finance that. So this case here, someone can come in, right? And then take over and then make more investment. The company actually will be able to generate a lot of higher profit in that case. The dividend will be a lot higher. So again, the opportunities, the investment opportunities, right? The possibility of the future investment could be perceived differently, right? So sometimes, given that a stress that the company could be undervalued. So, but again, I mean, if we know everything like this is how we calculate it, right? But unfortunately, nothing is as straightforward as this, especially about expected value, because we are talking about expected values. So that makes sense. A lot different. Okay, if we forego growth and plan no growth and plan to hold our stock indefinitely, this perpetuity. This is what we have. We know that, right? So perpetuity equals to P0, dividend divided by R. Okay, dividend divided by R, or we use this. This is kind of important here. We use EPS. Okay, EPS is what? EPS is the earnings per share. We use earnings per share. Okay, yeah. All earnings are paid to shareholders. In this case here, obviously, some of the companies we know they never pay any dividends, right? Okay, so if that's the case, obviously, dividends equal to 0. We really cannot use this model, right? We always use the earnings per share in that calculation. Now this is also related to some issues that we did before. Remember when we were calculating the cost of capital, right? Cost of capital. There's one thing that we say was that how do you calculate the growth rate? All right, one of this, of course, the dividend growth rate, right? Dividend growth rate. So some companies, they don't have any information on that because they just simply don't pay dividends. In this case, we use what? We use the earnings growth rate, right? In that model, earnings growth rate. I think we actually had that, right? We actually had that. Yeah, it's like. Oops, where's my eraser? Remember that formula we actually have, P0 equals to dividend, right? R minus G. The one that we actually to calculate that the price of that, right? We talked about actually, we actually going to mention this for this G here, right? The G. How do you what kind of G you're going to use? What kind of G you're going to use, right? This G is supposed to be the dividend growth rate, okay? Dividend growth rate, right? But again, we don't have a dividend, so you're going to have to use earnings growth rate to replace that. Actually, I think there's a formula there in the next few slides, okay? Next a few slides, we might be able to look at that. This is what we call, I think this is what it is, all right? Constant growth dividend model, version of dividend growth model, in which dividends grow at the constant rate. It's still called the Gordon growth model. And this is the one that people use all the time, okay? Use all the time. This is the one that I was writing, okay? P0, that is price of stock equals the dividend amount divided by R minus G, right? R is what? R is the cost of capital, okay? Cost of capital, or interest rate in that case, the market interest rate, right? And then G is the growth rate. G is the growth rate, right? So now how much this is going to be, right? So now I said a derivation. We've already done that, I think, right? One of the midterm exam problems, right? Actually asks us to sort of calculate how much that's going to be. And we actually have to use the growth model, so I'm not going to go through that again. All right. So given any combination of variables in the equation, you can always solve for any unknown variables. This is the one. Let's see here. We should have one example here. Okay. So one example. Okay. What's the value of stock that is expressed to pay $3 dividend next year, and then increase dividend rate at a rate of about 8% per year indefinitely, assume 12% expected return, right? Expected return, cost of capital. Stuff like that, same thing. All right. Okay, so how do we do that? Just simply substitute that into the formula. Okay, substitute that into the formula. So the dividend divided by R minus G, $3 divided by 12% minus 8%, $75. So the stock should be $75. Should worth $75. Now there are, of course, a lot of interesting things here. Okay, what we are saying is that if this company is this, do you really expect the price to be this much? I look at how the analysts evaluate, right, the companies, because a lot of times you look at one stock, right? The one stock is that they buy, sell, or hold, right? They actually have stock recommendations, right? Do they do this kind of calculation? They look at that as well. They look at a bunch of other indicators as well. So they're not going to just essentially look at one particular thing here. But in terms of valuation, this is one of the things they all have to perform. They will have to calculate, right? What is the important thing is about this ratio, okay? Because if you look at the growth rate, dividend growth rate, or the earnings growth rate, a lot of analysts actually have different opinions about the growth rate, right? So some financial services actually, they provide the service to give you guys about, hey, what is the average earnings growth rate predictions by the company, by the analysts, right? So they do that. And in that case, then the value of this would be different. They really depend on the analyst, whoever performs that analysis. All right, let's finish up this example. We can actually then take a break. If the same stock is selling for $100 in the stock market, So it's $100, not $75, okay? Because we said it is $75, right, according to that formula. But the stock price actually is $100. So the question asks us about what is the dividend growth rate? All right, what is the dividend growth rate? So in this case here, the G is unknown. So we can solve for G. So the G actually is 9% according to that, instead of 8%. Because if it's 8%, the stock should worth $75, right? The market actually value is at $100, which means that people are expecting their earnings growth rate to be higher than the 8%. So if you calculate that, that is $9. Okay, $9. And many times when you make the valuations for companies, and we just have to assume that it's actually going forever, not necessarily just for, so many number of years. We are going to make some assumptions about that, change some of the assumptions in the next few slides. But generally speaking, this is what we have. Okay, so let me just make that a last slide before the break. What happens if we have a company's dividend that is not growing at a constant rate, right? Look at that here. We have different dividend at different time. This is very straightforward. What I'm going to do is essentially put in the dividend amount. Sometimes that happens because for some companies in the early years, the dividend growth rate is higher, right, compared to later years. Because at the very beginning, they may want to attract more investors. Sometimes they believe, hey, if I give out a lot of dividend, right, the investors seem to be, to be able to get more interested in that. But gradually, they're probably not going to pay out that much of a dividend. Why? Because they want to retain some of the earnings for their future investment needs, right? So sometimes the company's strategy may change. So in that case, then the future dividend amount actually maybe lower, right? They retain more. So that is determined by company's dividend payout policy. And then in that case, just discount all the dividend, future dividend flows. And then we calculate the, also have the horizon value, okay, pH, whatever the value that is at the last of the periods of the holding. And that would be the value of the stock, okay. Well, this may be the last slide. Another example, a couple of examples here. Let's take a break and we can look at that. Okay, so I'm going to just put it here. Okay, any questions, guys, before we take a break? After break, we'll talk about that. Pause it.
Are you going outside or?
Going what, outside? No, I'll stay inside. I'm going to look at it. Yeah, I can go over there if you want. Okay.
How much is that servicing debt? I used the interest expense and or in total debt repaid. So is that, I can download the Form 10K statement, but I downloaded it.
Next day and say you didn't have
I pasted, copied and pasted something right here.
Now, what did you just do that?
I did it last month.
Okay, well, that's good enough. I farmed it out in 2013, which, I mean, I
Sorry,
got
this is
Windows
really
8
small.
now.
I don't like Windows.
Have you tried it?
Yeah, I had this one for 2 years now. Well, since I was in house.
Is it the touchscreen one or? Well, maybe because the touchscreen
The touchscreen will make it way easier.
Yes, that's why I like it.
I just got it upgraded, I just did the upgrade on this one.
Okay.
Anyway, I didn't know you were about a computer person, I guess I thought about it since the other one had an accident.
Oh, yeah.
Yeah, you probably need to include short-term debt as well. Because that's long-term and short-term debt.
Okay, so what about interest expense?
The interest expense is not, this is part of
That's not-
that you pay, this is not the, the,
It's not the part of the debt.
the paid.
Debt, okay.
Yeah, it's just interest payments.
So it's just the amount spent on the debt
Yes.
for long term and it's not here.
Long-term debt.
But this is the debt they have, not debt they
Not
get
they
paid
get
on.
paid.
Okay, I think it's here. This is actual.
You look at consolidated.
Okay, so this was something I was looking at. What about, like, these are loans that.
That's a loan they took out.
Okay, so that's not what they do.
One thing you can do is look, one thing you can do, cash pay to purchase that.
Cash paid to purchase the debt, so that's different, right? That's not servicing debt, it's somewhere else.
This is part of your service debt.
Really?
Purchase debt.
Isn't that like the example you gave us where if you're getting a mortgage, you have points, and you have to pay those points? So you're really, if you have 2 points and you're borrowing 100,000, they give you 98,000, but you're paying interest of 100,000, right? So that 2,000, wouldn't that be the cash paid to purchase the debt?
That's not how it's. This is part of that last thing.
So you pay that after?
No, this is like the reduced amount of debt.
Right, you're not getting the total amount of
This-
the money you're borrowing, because you're paying that,
Yeah.
right?
No, this is not. This purchase, oh, I see what I mean. You are talking about the transaction cost, is that what it is?
Right, well, the cost of.
A cost of purchasing the debt.
Yeah.
I don't think this is a cost of purchasing, because the cost of purchasing debt wouldn't be this high. $4,000 million, $4 trillion. That's not gonna be that much, cannot be that much. It has
But
to be-
they borrow billions, they.
Yeah, this is $4 billion here, okay?
Yeah,
Yeah, see that is basically $4 billion.
yeah, right.
The transaction cost cannot be. Okay, so this is
So
retirement,
this is,
retirement of
payment
debt,
on the
payment
debt?
on the debt.
okay,
Yeah, payment on debt.
so that would be money for servicing the debt.
Service to debt. Yeah, that's the service.
There's another one where it has the amount of money that they paid that year compared to the amount of money that they paid in 2011, and I was thinking, well, if they
Amount of
pay
money
more,
paid that year, pay for what?
pay for the debt, to settle the debt. There are so many tables.
Yeah, there are lots of little details stuff there, but that's not that. I mean, usually what you can do is to look at this
Okay.
financial statements.
What about, oh, sorry, what about this stuff?
These are
They're
interest
not- oh,
rates.
these
These
are
are
the
the debt
rates.
interest rates.
Okay, interest, oh, no, this is interest
Interest
expense,
expense.
yeah. Oh, consolidated, is this what you were saying to look
Yeah,
at?
consolidated the financial statements.
Should I click on
Yeah,
this?
click on the balance
Or is
sheet.
this?
Balance sheet will give you the amount of debt actually has changed. Okay, so you actually have, if you look at that, their current asset, right? So you have changes there, and the short-term debt.
That's short-term assets.
That's short-term asset.
This is, okay, yeah, long-term debt.
Yeah, there's
is
liabilities
here.
there. Yes. Yes.
And then total long-term liabilities, this is short-term debt. Okay, so what would I say is for servicing the debt?
Um,
That would just be that 4 million, a billion over there?
Yeah, here you don't have, here for the, the balance sheets, what they usually have is the amount change in debts, right? The total liabilities. So you don't have that. One of the things is the interest expense, that's just paid on the interest. Okay. And the one you have to probably go back to the original one, you actually have how much they paid. That's just cash paid for.
The 4 million, is that what you're talking about?
That's the,
For that year?
yeah.
Okay. And then, so that was about that one. And then for this, how much debt does the company have?
Yes.
Is that their total liabilities?
Total debt, liabilities, yeah, short-term
Because
liability.
I got this
From what?
online and it says net debt
Short-term
is
debt.
short-term debt plus long-term debt
Yeah.
minus cash and cash equivalent.
Yeah,
But I
this-
wasn't sure if that's what you meant. Like
Yeah,
how
well,
much debt does the company have?
Well, mostly, if you don't look at the cash equivalent mortgage bank, it's basically
Just short-term
short-term
debt
debt,
or
long-term
long-term
debt.
debt?
Yeah,
Okay.
that is.
Okay, and then.
One of the things is that if you get into too much details of that, then you're gonna, just use whatever we have.
Okay.
That would be good enough for us to do that.
And then I had a question about, this is fine, I had a question about here. Is the company taking on or reducing debt? So what I did was the total liability
Liability
was
is
this
this.
in 2011,
Yeah.
and then total liability was this in 2012. So since
It's
it
reducing
reduced,
that.
I
So
said
you
it's
look at
reducing
that.
debt.
Look at the math.
So is that fine?
Look at that.
Okay. And
They may
then,
have to do that, right?
Right.
But then
they
pay
paid off
all the
more.
one. So the net one is essentially.
okay. And then for here where it says, what are the company's total reserves?
Right.
They have proof
They should have a table
developed,
there.
yeah, there is a table, but I was confused as to what to pick. I don't know why you can't get the tank figured out, it's so difficult to navigate.
It's before the financial statements.
It was somewhere in the middle. Oh,
It's the financial, this is financial.
okay. I had this one.
Okay, is this the PDF?
No, I can't get it as a
Yeah,
PDF.
you can, have to search,
Yeah, okay, well,
That's just.
okay,
Yeah.
yes, this is it.
Yes.
So there's total proved though, and then there's proof, there's
Okay.
natural gas oil, natural gas liquids, and total.
Total, yes.
So should I use
Use a
total?
total, yes. Use
But
a
that's a
total.
BCF equivalent.
Yes.
Okay, so when I want to calculate the current price, do I, at the current price of oil and gas though, I have to use only the
Well,
price
did
of gas?
the question ask you about the total value or?
Here, it just says what's the company total reserve.
Yeah,
So
that's
I
what you
use
need to
that.
have. You don't need to have the price or.
Yeah, but then you also say what is those reserves, the current price.
Oh, I see what I mean, yeah.
So the current price was.
Just use whatever the value you have and then, multiply by that.
Yeah, but this is in BTU, and then that's in,
Which one is the BTU?
the price of gas.
Yes.
Yes,
Okay.
yeah.
1.023.
To convert it to cubic feet?
If it's in MMBTU,
Yeah.
multiplied by 1.023.
Yeah, that's converted to cubic feet.
And SCF.
That would be
MCF, yeah.
MS. Okay, and, thank you.
Yeah, I mean, if you use that approximate relationship, just one,
It's almost the
One
same.
time.
It'll go up just a little bit.
Okay. And SCF. Okay.
yeah.
And then also, the standardized measure I got from the table.
The table has the
This.
standard measure, yes.
That.
Yeah, that
So
is
it's
the-
it's a
that-
dollar
That's the
amount.
number, yes, that's the dollar amount that you just extract that from.
Okay.
Okay.
And then the reserve replacement ratio I read was the amount of approved reserves added to a company's reserve base during the year relative to the amount of oil and gas produced. So I could find the amount of oil and gas they produced, the total
This one
was,
here?
yeah, but I couldn't get the amount of approved reserves
Well,
added to the company.
Did you look at that, from this
This
one
was
here?
approved, developed for 2012, but.
You don't have 11.
mm,
Jane, you did have some number from the previous year, right, the reserve?
Well, okay, so they had, they had at the beginning of.
Yeah, the
period
beginning and the
period.
end of the
So
period.
just the difference is
Yeah.
okay,
Yeah.
got
Also,
it.
see here, you actually have a revision, right?
Yeah,
Table whatever, so that, the difference here is
is the amount
Yeah,
added on,
it's
but
the
it's
amount
a
added.
loss though.
it is a loss
Yeah.
in this case.
Okay,
Yeah,
okay,
yeah.
all right.
Yeah, so this actually is kind of consistent with what you have there, because they actually have a revision. The revision actually reduces the amount of reserve they have. Yeah. So it's basically the net. As a matter of fact, this one here, at the final level, is actually lower than the beginning level. So it is a loss in the reserve. Yeah. But then, sometimes we look at that, the ratio is negative number, right?
Yeah.
Doesn't mean anything. And usually it will mean a lot of things if we just cost it back. Right?
So
So,
does
but
it-
whatever
does
you
it-
have, just put in there.
Okay,
Yeah.
but does it mean anything though, if it's?
Well, it
negative?
was a negative, just means it's a reduction, right? You didn't have anything added, so, typically we look at numbers which we need to look for the positive value, that gave you some meaningful, but it's a negative then. And again, it's negative because of the change in the estimate, but for whatever reason, it's just reduction in reserve.
Okay.
Did you look at that?
Oh, I forgot.
that's not-
Okay, please, send me.
Yeah,
I will-
that's.
I keep forgetting, I'll do it this, I'll put in my purchase for that. Thank you.
Yeah, sure. Okay, so,
Yeah.
I don't know,
I should change my position on
I'm jealous. I was so
this. It's gonna be,
confused over
it's actually
where
gonna
to
be
start
stockholder,
to
right?
be.
Well, I gotta go over this, I gotta drill it.
So,
Who's teaching that for that?
That's the same
on
one.
the revision, I understand what you're saying
What's
there.
drilling house?
So you would add that to,
Oh,
or in this
Sure,
case,
yeah.
subtract it.
Subtracted that, yes.
And that's actually gonna be the net.
Yes.
Um,
Yeah, because actually, Danny actually has a table, it shows that, the reserve beginning, and then whatever, it's the deviation, whatever, and then finally they came up with the level at the end of the period. So that actually includes the deviation. It is a net change.
change
Net
that
change is positive.
difference.
Yes.
yeah.
Now, am I gonna divide that by both sales and
Reduction. Reduction.
and you don't worry about it?
So
We don't need to, we don't worry about
The
that.
teachers are bad, well, so now.
Just,
They're,
zero.
yeah,
The, reduction.
but, you're not
Which means
zero
then,
teacher.
yeah, but this actually fraction should be positive, right? The original number is negative, but the number there should be positive. A7, which means then the reserve increases then all the fraction of the production is growing.
Story bridge.
Although it has to.
Yeah.
That's fine, but it should be assets. So that way.
Yeah, it increases, but it's not, it's not increasing as the same speed.
Get some salt water to
Yeah,
that.
so assets.
The way,
Yeah.
the way I looked at this,
Yeah, but, I think the already not really necessarily all the I mean, because the increase.
I served off the
increase
Early Coast
probably
on
4.6.
For like
Not all
2 hours,
six,
I wore my wetsuit that I was wearing today, rolled that I wore.
Not much.
Reserves to change.
Well, usually you gotta wear a thicker reserve, it's a 4.3, and I was 3.2.
2011.
And they typically wear like the head thing, the gloves, the booties, but I was just like, I didn't have a head thing in reserve. So say that's.
I guess the way I look at it is, like, from here to here, you're gonna go up.
I keep,
There's a
keep out
change.
black.
Well, I see. Yeah, so, oh, I see, what do you mean, you actually have to compare from this point to this point.
That's the change.
Yeah, but then that changes, exactly this one.
My brother, I remember last time we were there.
No, because they have a revision.
But the revision is still,
Jumped in.
it doesn't have, the revision is part, just like, instead of discovering new ones, right? You lost that.
If you're moving to
It's
it,
actually still,
We're
what should I say, the part of the reserve, even though it's a decrease in reserve.
the chemical water in California,
It should actually be negative.
mid to high 50s.
That should be that part.
Probably.
Unless it happens to just get a current that brings in more water. I remember that when I was stationed in North Carolina, I could be there, Wilmington Beach. Everyone going to the west area, just blowing away. Because it, first of all, it's like 90 degrees out, super humid. You know, water is like 80 or, you know, water's like 80 something degrees. I'm like, this isn't even refreshing.
If we have a positive one, it simply means that we added this to reserve base, right? And then, if we are adding that, the ratio is more than one, okay, still we actually have a fraction of reduction. So you still don't be able to base our reserve because negative in that way.
Cleveland County for the last election.
Because it's nice, you know how
Okay,
it
look at
says
that
when
map, it's like pink instead of dark red.
Yeah. How much debt is it?
I mean, you don't have
I have decided, the definition to move stuff from the block. So now they're totally reserved. I mean, of course, instead of people saying these are ours, then that increase is not that.
If it's, it goes, if you're not a Democrat when you're young, when you don't have a heart, and you are not a Republican, I think it's actually liberal or conservative, you're not conservative when you're old.
I don't have, sorry, just a quick question. I don't have short-term in mind. I just have accrued expenses and accounts.
Absolutely.
Do I need to
Account
pay
payable is
payable?
not a debt.
Should be.
Not a debt? So, I accrued expenses is not debt.
But I've been like
So if I
that.
don't have short-term debt, it's just my long-term debt.
The short-term debt, you have that kind of everything else, stuff like that, you borrow from the bank, from
I don't
whatever.
have.
Then it's just what happens.
Yeah, we don't have it. Okay, this is what I showed you, because I just, you know how they have oil, gas, natural gas, filters, and then oil? Yeah, I just was like, so what I asked him was, since I
Yes,
just.
because they say it's not 100%.
My total was 6.6, oh, sorry, no, 15.6 trillion.
It's just a new
So,
Then the
say,
so you just multiply that. Price times 1.023. So change it. I multiply that by that.
Yeah, I think, the original idea is like have 99. For example, just simplify this, if you have 99, but then you have to choose 100.
I need to submit my survey.
So then, what are we going to cover? So
So that should be the
replace what are we going to
So, here you're changing.
I just
So,
wrote
the ratio.
Yeah.
The way you're saying.
We've got this like database, they go through and they like.
There's gonna be a set volume that you should use, and that's what you write.
So,
Right, that's what I'm saying,
So that, if you're going to watch sub data is that, it did not have enough to cover.
Yeah, but then what if it had
I made it to like 500, but today after lunch,
Or,
it stopped.
sorry,
So I
this
guess
thing,
what I
I
want to
forgot
say
the
to
term, revisiting,
Perfect.
revisions.
Like,
Yeah,
I don't know what
so they have
happened. I went to lunch, I came back, and I just kept chugging along.
So what you did was use,
This is for the
Didn't
10,
save
yeah.
So basically, that report is finalized.
because the way I understood it, you want
Well,
one
sometimes they put another.
The areas is so much easier. All you want to do is just say, manual redo, best fit.
You don't think so? Because I
And like
saw
for this
one
food,
for
like,
years
that's what
ago.
happened, they're reading
You're looking
everything.
at
Like when I was doing
Oh, yeah, I know it's one, but if a revision happens during school year, then they have to say the next
They just told me that's also like, at least for the.
I see what the difference. Yeah.
Which means.
It's gonna be a lot.
I guess
Yeah, well, but
it's the same thing.
did you
It's
notice
one
what
way
they
different.
did?
It makes sense to you.
Like, if you just subtract what.
I guess I just didn't understand it.
Well, if you have that, I don't think that's a problem, but I like to have a kind of a
Yeah, I'm
standard
thinking there has to be.
Yeah.
So what I'll do is I will sort of, on that part.
What if they set it off? What if,
Yeah.
what if they sell some of their
This way is company that's why it's isolated.
right, they sell off some of their leases or.
Relatively, but not
This is the.
I tried to do all that stuff.
Family is from 51.
That's not really mean much, that's anymore, because we can't prove it. Yeah, yeah, I was like, I did spreadsheets and stuff to do this, we're like, we can't use it because it's. Why is this big?
It's shy.
All because I have included the production in there.
If you only increase it by 9,
See, here's the replacement issues, you have spike, this is, the quarter, I'm plotting it based on all of let's go with that, the other reason I'm saying about this, look at this curve, the green part of the reserve production ratio.
Yes.
It's on this side.
Basically, you got two fractions.
You have worldwide production is increasing, worldwide reserve is
Well, it's coming out.
You're producing more.
Has the cracks come out here.
Right. Produce, it even says in there, you actually have a high production.
It essentially, everyone's kind of 50 type of bulb.
So we have to take the line.
Too high.
Yeah, what is that?
You have resume, you have reserve. You're not producing.
But you still want it to be at least
Let me,
100%.
And then form that.
Yeah, because you want to, if it's lower than 100%, you want more than you're replacing.
Yes, just one of the
You want it to be, I don't know, I read
Similar,
it.
you just don't have
Yeah, that's fine. What I'll do is I will now a standard comprehension from this problem, but, you know, so that's.
Yeah, some of the stuff you do is.
Previous
Well, I
year.
guess,
Like, I have all those, I have all those spreadsheets.
whatever.
Yeah, that's why I was thinking, because I was looking at other states they have their non-farm outcome, they actually include all the factors, not just in slaughter, but they also
Correct.
irrigation.
Because like they just, I mean, they have like a data, their database of 15,000.
Yeah, because the reserves
And
decrease.
it's broken up into projects.
Yeah, mine
It's like you're here project.
So you're going down.
bucks.
There should be a measure.
Mine would be better.
Yeah. No, I'm grabbing, I'm pretty sure they said that every September.
This purchase is actually.
So.
Part of that increase, just like
Everyone
everyone
else,
else,
like,
and the sold is going to be reductions. We'll just use whatever the definition.
And I mean, like,
Some allowed,
so it's like a dude that's gonna answer that.
This sub's like nine, so it's like
You said 25th, right? So it's gonna get some-
Tomorrow, yeah, that'll be fine. All right. Yeah, David?
Can you go with the reserve replacement ratios again?
Yeah, actually, Gene and I were actually talking about the reserve replacement ratio. All right, so I think we have probably we need to actually let's just get the. All right. The definition from that side, what I call investor,
Investopedia.
okay, Investopedia is what? Is the discovery.
The
Prove
amount
added,
of proofs
so
reserved.
discoveries.
Discoveries, right,
I
discoveries.
think you should say proved added reserves, because that would be like discoveries plus, you know, purchase.
Yeah, whatever that, just net, right? Minus the revision amount, minus the amount sold, plus the amount of bought, whatever that is, the one. Just the new, just added amount. That is the added amount. So added amount divided by
Basically, the proof.
The amount produced.
subtracted, really.
amount
The
of
amount
production.
produced, yeah,
Is that for that year, or is it for like?
for that year.
So
Within that year period,
So this would be the difference between.
the beginning and the end.
Yes.
But you could also, I think it should actually be revised and it should be the reduction, not production, because you can have production, you can have sales, and you can also have adjustments as well on these sheets.
Yeah, there are several things. One is an adjustment, right? Adjustment to the reserve. Is that what you're saying, Jay? Right?
I mean, you told me it needed to be included.
I would think that, for that product, if it is revision, whatever, the adjustment should be part of it. So. Because whatever that is, right, it's not adding, suppose if it reduces the reserve base, it's just like the decrease in the discovery. Because you might have discovered 50, right? But actually the revision actually decreased the total by 20. So the net actually is just like you only have made a new discovery with 30. That's why I believe that we should take this revision into consideration, not just this total here. I don't know if it makes sense or not. I mean, that's just what I would think, right?
The way they do the balance sheets, I think you're correct, because basically the reserves replacement ratio is going to be whatever you added to your reserves that year, over whatever you subtracted.
Yes.
So are you saying we need to add the revisions again? But isn't the revisions already in there?
Yours, in that particular case, there's a table, the revisions already included.
Yeah, so I don't need to.
You don't need to do that, right? I mean, this is because Damien actually has a table that shows the net, actually.
See, for like one, I picked up and what I did was they actually have a chart where they show the actual reserves to production, and basically I just took the delta between 2012 and 2011 for the reserves, divided that by
By the production. That's what I was originally thinking.
Okay.
That's what I was originally thinking. But again, let me do this, okay? Just do whatever you have now.
Okay.
I'm going to give you a standard answer, try to give you a standard answer next time, okay? But whatever you are doing, that's fine, it's not a problem, okay? You can use whatever the method you had before. Right? I'm going to give you an answer on that part, okay? On that part. I'm going to look at that from different places and then see, how these things are different. Okay, guys? All right. Okay. Can we, do we have any other things that we need to discuss? All right, if not, then let's just move on. Remember we said we actually have if we have non-constant growth dividend, right? So this is how we're going to be able to evaluate these stocks, common stocks, present value equal to those. So the example here is, has been growing at the rate of about 20% per year and expect this growth rate in earnings dividend to continue for another 3 years. All right. Okay. If the last dividend paid was $2, what will be the next dividend be? Well, that's very straightforward, right? Next dividend is 20%, so that will be $2.50, $2.40. Right. So this is part A here. We have $2 times the 120%, so $2.40. So that would be the next one. And the year 3 would be another 120%, right? 120%. So, which means that for the first year, that's $2.40, and then $2.88, and $3.456. All right. If the discount rate is 50% and the steady growth rate after 3 years is 4%. You know, what's the difference? The difference is that the first 3 years, right, the growth rate is different. And then starting from 4th year on, then we actually have a 4% dividend growth rate. It's lowered to 4% from 20%. Right? So we have to calculate these things separately. Calculate that separately. That is, you know, we have used the dividend growth model to calculate the price that as of year 3, right? Using that model, basically $2.56. That's the number we're going to receive, and then multiply by the 4% for the next year. 4% by the next year. That's why we actually have that's multiplied by 1.04, right? So that's actually the dividend amount starting the 4th year on and forever, okay? And then minus that divided by the 50% cost of capital, as well as the you know, the 4% growth rate. We'll come up with 32.675. That is the value of the stock as of the year end of the year 3. At the end of year 3, right? So we end up with 28.021. That is the price of stock. Okay, guys. Oops, I did not turn it on. This is better. Okay.
Did you resume the recording?
Yeah, it is recording, and then the number is actually changing. I don't know. It looks like I might not have paused it. I pushed it. Probably didn't really work.
Oh,
So during the break,
all the time.
yeah, during the break, I might be recording all the time. So seems to be the case. So the counter actually is keep going. So all right. Thanks for the reminder, because you know, sometimes that happens. All right, so that is that example. Another example. All right. So we actually have a 4 years ago it was near bankruptcy. Today it announced a $1 per share dividend to be paid a year from now. The first dividend since the crisis. And now analysts expect dividend to increase by $1 a year for another 2 years. After the 3rd year, in which the dividend are $3 per share, dividend growth is expected to settle down to the more moderate long-term growth rate of 6%. And the cost of capital is 14%. What expect to return is 14%. What must be its price? I mean, in this case here, you actually have, again, the same thing, right? You have change in dividend amount. And then just calculate the value of stock as of year 3, right, end of year 3, and then just do that. So dividend amount 1, 2, 3, and then calculate the another price. That's the same thing, right? So the same thing, especially this part here. This part here. So we can calculate the using the dividend growth model, right, to calculate the value of the stock. So we can calculate the total, I mean the overall stock price to be equal to $31.27. Okay. All right. What happens then if the firm elects to pay a lower dividend and reinvest the funds? So what happens then is this is something we are talking about here, okay? Because the future dividend may be higher. Now this is a lot different because a lot of times we are saying that, you know, the stock price should be based on discounted dividend flows, right, from the future. But the company actually is changing their dividend policy. So they are withholding more of dividend as retained earnings to make more investment. Therefore, it's not really given to the stock owners. Now what's going to happen? What we are saying here is if you make that investment and then your future dividends may be higher, then that's going to increase the value of the stock. All right, so we're going to have to look at the payout ratio, so-called plowback ratio, which is the part that you retain and return in earnings. That's what we call the plowback ratio, right? The payout ratio is the percentage you paid out. And this is the percentage you retained. Okay, so the sustainable growth rate is the steady rate at which the company grow, return on equity, pullback ratio. All right, so we're going to look at the example there. All right, so here, what we have here is the growth can be derived from applying return on equity to the percentage of earnings plowed back into operations. So we'll look at an example to see how we actually can calculate the stock price in this particular situation. So the G is return on equity times the plowback ratio. Look at the, you know, we actually have a formula there, right? But anyway, we're going to look at the example here. All right. Company forecast to pay a $5 dividend next year. It's 100% of the earnings, so it's all paid as a dividend. All right, so there will be a 12% expected return. Okay, this will be a 12% expected return. Instead, we decide to plow back 40% of earnings at the firm's current return on equity of 20%. Okay, so what is the value of the stock before and after the plowback decision? So what happens then is, of course, sometimes we know that this decision changes is going to affect the stock price. Right? So what we have to do is to calculate the value before and after. Right? So no growth, first one, is the no growth. Right? No growth. No growth, of course, as we said, the cost of capital is what? 12%. Right? 12%. And dividend is $5. So it's 5 divided by 12%. Right? So the no growth stock price is 41.67. Okay, 41.67. And then we're going to pull back 40% of earnings, right? 40% of earnings. So if the pull back 40% of earnings, the dividend amount actually will be reduced to $3 because the original is paying $5, right? And then we are giving back 60% of it, right? Because with 40% actually the company retained it. So the dividend amount becomes 3%, right? 3%. Then we actually have the growth rate in this case here, as we have calculated here, right? The growth rate should be equal to return on equity, okay? Return on equity, and then times the plowback ratio. In this case, the return on equity is 20%, right? 20%, and then 40% is the plowback ratio. So the growth rate should be equal to 0.2 times 0.4. And then that's equal to 8%. Okay, 8%. All right, so what is the stock price? Stock price, then we have to use that dividend growth model to calculate the stock price. Then that's equal to 75%. Right? So the point here is that if we decide to do that, the stock price actually will be higher, right? As a result of this, because of the growth rate. Growth rate. All right. So if the company did not pull back some earnings, the stock price will be at. That's just the conclusion, right? The difference, all right? The difference between these two numbers, $75 minus $41, 7 cents equals 33.33. This is what we called the present value of the growth opportunities. This is just in, a little bit of definition. Present value of growth opportunities, right, equal to 33.33. So when the government, when the company changed dividend policy, actually, they increased firm's value by 33.33 cents. Okay, that represents the net present value of firm's future investment. Right, so because of that change, make the future investment, that increases the value of the firm. Okay, so I guess from this point on, we have pretty much calculated the possible values of the company's stock by using different method, right? The one that we used is the dividend, right? Discount model. We use that with growth, without growth, the dividend growth, right? With dividend discount model. That's what I was saying. Dividend discount model. Okay, dividend discount model with growth and without growth. So we went over some cases there, right? So basically, the principle with this method is to discount the and the dividend, right? The dividend, and then adjust. If we have a growth perspective, we can adjust for that growth rate. Just a couple formula, right? A couple formulas. All right. So next one, I think what we're going to do is to look at some of these. Let me look at it. Yeah, anomalies. Okay, anomalies and okay, anomalies in the some kind of analysis. So far, we have introduced the so-called the fundamental analysis. Okay, the fundamental analysis. Look at the company financial the fundamentals, the bottom lines, and then to evaluate the stock price. But there's another one here, which is the technical analysis. Very briefly, I'm not going to go through all of this. The technical analysis, this applies to a lot of the asset market as well. You don't really value a company's stock by looking at the fundamentals. You just look at the past history. Okay, look at the lines, whatever that changed. Okay, so this is what we call the technical analysis. Right? It's basically sometimes we call it chartist. Do we have anything here? No, we don't have any. Okay, look at the chartist. You look at the charts, stock price charts, and decide on the future movement of the stocks. Right. So this is what we call the technical analysis. We don't look at the fundamentals. It's pretty much we have two kinds. One is the technical analysis. Another one is what we call the fundamental analysis. Right. So these are two things. Okay. So we can attempt to identify undervalued stocks by searching for patterns in the past stock prices, right, based on watching fluctuations in historical prices. All right. I don't have any charts here. Okay. Well, they talk about moving averages. For example, you use that as a method to analyze stock price and look at a lot of different things. The bottom or the resistance levels. They use a lot of different things to do that. Okay. We're not going to get into the details. Now, what this says is the random walk is what we call why there's no free lunch, all right, which means that you really can't look at the stock price from the past and then try to find out the pattern in the stock prices in the future. This is what we meant. There's no free lunch. Basically, what we are saying is the stock price basically follows the random walk process. Okay, you really can't predict it. You really cannot predict it. Okay, so look at the pattern here. Okay, do we see any pattern? Look at the long term. Horizontal axis here, we have a return in week. Okay, in that particular week, that's a return. We have a lot of different. This is where I'm talking about the New York Stock Exchange Composite Index. All right, so look at a certain time period. Look at the weekly returns. Okay, percentage changes over two successive weeks. So the percentage changes, and then the vertical axis is the following week. Right, so you look at this week and then the following week's return. Basically, what we are saying is that if these things work, what we will be able to do is essentially look at the past week's return and predict this return, right? This week's return. Or look at this week's return and predict next week's return. So we are looking at two successive weeks' returns. Do we see any patterns here? There's no pattern here, right? Just all over the map. Okay, all over the map. So clearly, there's no pattern in this. If there's a pattern, for example, what we believe is that the stock price is going to get higher if the previous week's price is higher. Then this week's price is going to be higher. This actually is going to create some kind of positive autocorrelation, right? Positive autocorrelation between the stock price. Right, the stock price, we're going to have, say, price get higher and higher. Now, sometimes people talk about this as if there's such a thing like this. If there's a positive autocorrelation. Now, this is kind of sign of what we call herding. Right, we're going to have some of these things later on. Herding. What do you mean by herding? Well, basically, what we are saying is that, when we are analyzing the stock market change, we're not looking at the fundamentals. We are looking at what we are doing, what our neighbors are doing, what are the other people doing. So if they purchase, we're going to purchase, right? So if you sell, we're going to sell. Now, if we have that kind of behavior, as we said, herding behavior, because if you actually have a head sheep going that way, all the other sheep which basically follow, right? That's just kind of herding. If that happens, then we're going to probably see not this way. What we're going to see is probably something like this. right? Positive followed by positive, negative followed by negative. So you should see this kind of a connection instead of this kind of random walk type of plot, right? That actually will be opposite of this, right? Will be opposite of this. So from that, we don't see any herding behavior, right? Looks like it. But we have a lot of studies in this area, so I think later on we're going to talk a little bit about it. Okay, talk a little bit about it, and that may be reasonable. All right, may be reasonable. So the random walk basically says that there's no predictive trend or patterns. Is that really the case? There's no predictive pattern or trend. Well, some people argue, well, that's not really the case, right? Some people argue, yeah, it is the case. If you look at the market there, right, you really can't find any kind of pattern. But as we're going to talk about that, we do have some kind of market anomalies. So we come back to this Nobel Prize winning economists, or financial economists, actually. There are economists, and even though these are professors of finance, right? But they are economists, in that sense. All right, so we actually do have some kind of anomalies. That is, you really can't explain this kind of pattern by using the random walk type of explanation. Right? Basically, Eugene Fama and some other people basically saying that the market is very efficient in processing information. Okay, so you really cannot have that kind of thing. But Robert Shiller basically said, well, if that's the case, then you just look at stock market price volatility, the price fluctuations, right? It really cannot be explained by normal kind of information flow into the market. Okay, you really cannot explain that. There's got to be something else that's driving the stock market fluctuation, stock market movement. Something else there. But what are they? All right, so this is something we really have to explain it. So the next few slides explain some of the anomalies observed in the marketplace. And according to the efficient market hypothesis, it shouldn't even happen, but it happens. And then if you trade that according to that, and you might be able to actually gain. So there's a free lunch. It's not like there's no free lunch. There may be free lunch. All right, so one thing is what we call the earnings announcement puzzle. Stock with best earnings news outperformed the stocks with the worst earnings news by more than 4% during the 2 months following the earnings announcement. Now this is the empirical observation, okay? Of course, you might be able to try to explain it away by using different explanations, different theories. But what that says is that if someone is trying to find a pattern here, right, and then trade according to this rule, overall, you're going to actually be able to beat the market. Okay, you'll be ahead. You're going to gain. Now, according to the EMH efficient market hypothesis, that shouldn't be possible, right? That shouldn't be possible. So we do have a pattern here. A new issue puzzle. Earning gain from new issues often turn into losses at the longer holding horizons. Now, when I say often, we are talking about on average. We're not talking about the Facebook, right? Facebook actually, initial offering actually didn't have a gain. They actually had a loss, right? But eventually the loss turned into gain. But what that says is, for most of it, if you look at all these the new issues on average, okay, you have a gain. But over time, you're going to lose. This is what it is. So what does that mean? That means that, hey, if you actually have bought these new issues on average, right, for holding a short period of time, it should actually have a pretty decent return. But before you hold on for too long, what should you say? What should you do? Sell it, right? Sell it. Then you're going to be able to avoid the loss. Okay. But that's the problem. If everybody does that, what's going to happen, right? You think about that, right? Think about this. I mean, even this is not true. Even this is not true. The second bullet point we're talking about here, it is not true. But if everyone is doing this, what's going to happen? You're going to end up with a loss because everybody's selling that, right? If everybody's selling it, then regardless, you don't really take a look at the fundamentals, and then the market price is going to drop. You're going to actually turn the gain into loss. So this is what we call the new issue puzzle. Right, so there are some of these old anomalies. Right? This is actually the small firm effect. Okay, this actually is kind of interesting. Look at that, right? Small firm effect. What do you mean by that? A theory holds that small firms, the companies with a small market capitalization, actually does better than the large firms. Large firms. Now, if that's the case, what we're going to do then is, we just simply buy stocks of small companies, right? Small caps. If you look at that, small caps, some companies many times do outperform the large caps. Okay, so this is actually is a factor used to explain superior returns in the three-factor models created by Jean Fama and Kenneth French, Fama and French, right? The first guy is the one that won the prize. The three-factor being the asset market, being the market return. The second one is the companies with high book-to-market values. The third one is the small stock capitalization. So this is a little bit some of these things that I need to explain a little bit. All right. At the very beginning, we actually had the market model. Right. What's the market model? Okay. This is actually, we said the CAPM model, right? CAPM model, capital asset pricing model. It's a one-factor model. It's what we call the one-factor model. What's the one factor? The factor is the market return, right? The market return, right? So what we have here is return, not free rate on that particular company equal to the free rate plus the beta, right? And then the market risk premium. So we have R M minus RF. So this is what we call the CAPM model. In this particular case here, the stock return is determined by basically the market return, right? But then people find out actually the CAPM doesn't really capture the stock return really well, right? So that's why we have alternative theories introduced into that. Then Fama and French, basically, they actually have so-called APT model, okay? Arbitrage pricing. What's this T stand for? Forgot. Theory. I think that's right. Yeah. Arbitrage pricing theory. Okay. What that says is that they actually have kind of an elegant derivation of these things. What they're saying is that it's not going to be just one factor. That's what we said here. There are three factors. So mostly these people actually, Fama and French, they have been doing the empirical work. They are not really theorists. Okay. They've been doing a lot of the empirical work, the data tests, all these things. They found out actually these three factors seem to explain the stock returns of the company pretty well. Right? So that's what we call the three-factor model. So one of the things is the small stock capitalization in this case. So you have superior returns, which means then that gives us some kind of guidance as to how to purchase stocks, right? So this again is kind of not consistent with the efficient market hypothesis in that case because there's a pattern. Okay, the theory actually says that the small companies have greater amount of opportunity than large companies, right? So have more volatile business environment, whatever that is. So, you can say the small companies actually is a little bit riskier than the large companies, right? Therefore, they should have a higher returns, right? Higher returns. Okay, they should perform better than the other ones. Okay, so now that tend to be true. Right, so finally, the small cap stock tend to have lower stock prices, and then low prices mean that price appreciations tend to be larger than the found amount large cap stocks. One of these implications here is related to the cost of capital. Right, so the cost of capital. That is, if we are talking about utilities, we said you can calculate the returns, the stock return on cost of capital of the small utilities by adding a small firm premium. Okay, small firm premium, small firm risk premium. Okay, and actually, as a matter of fact, many people do that. Right? Many people do that, and many people believe that's the case. Okay, and they actually have calculated what is the amount of small firm risk premium in that case. This is kind of related to, the small firm effect, right? Small firm effect. Right, so that is one. The January effect. Okay, January effect. And this actually is quite obvious. I mean, obvious in the sense that a lot of people actually did find this to be true by looking at the stocks. That is, what I mean by January effect, which means that if you purchase stocks tend to increase, gain during the month of January. Right? That tends to be the case, which means then what's the best time to buy? It's probably at the end of December, right? And then hold through that month of January. Then that just means then the stock price is going to be higher. The returns are going to be higher in January. This is what we call the January effect. Okay, January effect, which actually it is. People believe this is actually it's kind of reasonable. Why is that? Why in January we tend to have price appreciations? According to that, right? It's because what? We know that the companies do that, okay? Especially trading companies, they do this, or investors do that. What happens is in December, a lot of times that the investors will tend to sell the stocks that actually lost value during that year. Why is that? Because of the capital gain, right? Because you have some other investment that made a lot of money. So you really don't want to pay a lot of capital gain tax. So what you're going to do is to sell this company, the stocks that lost the money. So offset the capital gain. Does that happen? Yeah, you think about this. Actually, this happens, right? All right, then you can offset the capital gain. You don't have to pay that much of a tax. So what happens then next year, what you're going to do is buy it back. In January, you buy it back. Okay, you buy it back. So if everybody does this, obviously the price is going to drop, right, in December. But then the price is going to increase in January. So this is used to explain the January effect, which seems to be reasonable, right? But the problem then is, if the market is efficient, if everyone knows that, then you shouldn't even see the price change this way, right? You shouldn't even see the price change this way. So this is again is the market, so-called the market anomalies. But we do have some explanations, right, to explain away that the market anomaly. The PE effect, right? Situation where a portfolio with a lower average PE ratio has a higher return when adjusted risk than the portfolio with a higher ratio. Why is that? I mean, the company has one of the things we might going to say, well, the price PE ratio for this company is already too high, right? So the price appreciation is not going to really happen, right? Sometimes you're going to see that. But why this can't happen? I mean, if this is the case, if we know that, then everybody is going to buy the prices, buy the stock that has a lower PE ratio, right? Sell the stock with a higher PE ratio, right? If that's the case, then we shouldn't have even this thing observed. But actually, we do seem to observe this kind of phenomenon in the stock market, which means that there's something else going on there, right? It cannot be fully explained by the efficient market hypothesis. The market may not be exactly efficient. The neglected firm effect, the neglected firm effect. In that case, then the less known companies tend to do better than the well-known companies, right? So again, this is something we talk about that. I don't know what I have. I forgot what I have put in the explanations of this market. Let me just sort of go through this kind of quickly to see whether I have. If not, then what I'll do then is I will. Okay, I probably need to explain a little bit of some of these things. Okay, inefficient market kind of thing. All right. So we do have some of the market anomalies, right? Does that mean that it invalidates the efficient market hypothesis? And some people believe yes, it is true, because the efficient market hypothesis relies on the assumption of rational investors. Okay. However, you define this rational investors assumption, right? You got to be rational. But as a matter of fact, a lot of people are talking about, hey, the investors are not necessarily rational. They may be irrational. Okay, one of the things is Robert Shiller has been talking about this, right? The asset markets, the housing markets. He's been talking about the asset market, not just the housing market, but the technology stocks, for example, right? The tech sector. He has been talking about it for a long, long time. He's been saying that this sector, the technology sector, is being experienced so-called the irrational exuberance. And this is a term that people use a lot to describe this kind of situation in the asset market. The irrational exuberance. So that's not the right thing to do, and the market is going to crash. because the price is already deviated from the fundamentals for so long, for so much. So you're really not going to be able to sustain that kind of high price. So the market is going to crash. He actually pointed this out a long time ago, as long as in 1995, 1996, actually, he was saying that. But the market did not crash, right? The crash actually occurred 4 years later, year 2000, the market actually crashed. The IT sector crashed, right? Even the NASDAQ haven't really recovered to that pre-crash level yet. I mean, we know that Dow created, set a few records, right? Keep setting records. The S&P keeps setting records, but how about NASDAQ? It's still climbing, still yet to get to that point yet because of the high-tech stocks. So he actually has been saying that, but nobody actually was listening. What can you do to explain that? Irrational behavior that can be used as one of these things. What is irrational behavior? That includes the herding behavior, right? Sometimes that seems to happen because, for example, if you are a small investor and everyone else in the market has been selling, what are you going to do? You're not going to say, well, no, this is not right. Don't sell, okay, I'm going to buy it. No, you're not going to do that. What are you going to do? You're going to sell as well, right? You're going to sell as well because you not have enough capital, right, to do the opposite. You're not going to be able to hang on for that long time. So you're going to essentially follow the thing. Another explanation for that, is this still on?
No.
It's off? Okay, I don't know. Yeah, it's back. It's probably because of the battery. We don't have any extra battery. All right. Another thing is that a lot of times people talk about this, analysts or traders. Why traders do things like that? Because if you don't follow this, and it turned out to be the case that you are wrong, what's going to be the situation, the consequence? Yeah, I guess this is getting battery. This is a battery issue, just like last time. All right, so we don't have a lot of time left anyway. So for example, if I am a trader, the next desk trader has been selling it, right? But I didn't do that, and it turned out to be the case, and I lost a lot of money. What happened then is, I'm gonna get fired, right? But if this guy, everybody else is selling, I'm selling too, so everyone lost money. Is that okay? It's no big deal, right? You can say, well, he lost money too, I lost money, so it's no big deal. So if you stand out, then you're going to be in trouble. And this is actually why. It's psychology, right? It's a market psychology, basically. We use psychology. This is why we call it behavior finance. That you use humans' behavior to try to explain the trading behavior and therefore the price behavior. And then there's another study, actually, people talking about how the weather on Wall Street actually could affect the stock market performance. Does it make sense? Probably, right? If the weather is really bad, it's been raining all the time, you don't really feel that the market's going to do really well, right? So what happens then is, I'm going to sell. Okay, I'm not going to buy. I'm not going to be so aggressive. So if you actually happen to move the Wall Street to Oklahoma, the market's probably going up all the time, right? Because we don't have not much of a rain anyway, except for on the tornado days. Okay, but that just means that the psychology could be affected by factors other than the fundamentals. Looks like, right? So actually, this kind of approach uses what? Uses the the people's behavior, psychological theories to explain the stock price movement, which is sometimes we call it irrational, right? Irrational in the sense that we don't follow the stock, the fundamentals of the stocks.
Need some batteries?
Yeah, I think this is probably because of the battery. So, thank you. Sorry, that's a bit hard to get you back 4 of these to 100% return. Okay. Let's see here. Hey, this is better. Absolutely. Thank you, Jim. $100%?
Twice?
No, you shouldn't even said that, you know. Psychology. No, I'm afraid to lose this one, so that's why I couldn't get it. All right. I mean, we do see a lot of these things happening, okay, in the marketplace, right? So that's why, that sort of explains why we could have some of these anomalies. So it's not purely a random walk in a sense, sometimes. Okay. All right, so we can probably move on to other things. All right. So we have introduced several valuation methods and techniques. All right. So what we're going to do then is use a lot of different methods. IRS and the SEC recommend a number of guidelines for estimating values. Okay. So there are some of the basic principles here. So I want to go over this kind of quickly. Okay. The principles. Right? Initially applied to valuation of a closely held business or its common stocks, and then we can look at the stocks or business interest or any type for tax purposes determining the fair market value. All right, so it's basically what we're saying here is that in order to evaluate the company's stocks or business, you have to consider the following factor: business history, and book value, stock financial conditions of business, earning capacity, dividend paying capacity. So basically what we are saying here is that you have to consider a lot of different factors. Okay, a lot of different factors, right? So estimation value should be based on judgment after consideration of all factors. Considerable attitudes given regarding a particular factor or techniques, and so there's no just one standard method that you can use to evaluate. Here we have SEC ruling. There are 8 factors. Right? One instance you can have a look at it: current market price, historical market price, net book value, and a lot of different values, opinions, appraisals. Okay, so which means then that just added the complexities, right, to the valuation process, because you don't have a single equation there that you can use to evaluate. So you have to consider lots of different things, right? Lots of different things in order to come up with a fair value that I believe that should reflect the true value or true worthiness of the business. Okay, book value, we already talked about that. Okay, so book value or owner's equity is equal to the common stocks, right? Common stocks. So we're talking about the owner's equity here, equals common stocks plus paid-in surpluses plus retained earnings. All right. So what is the paid-in surpluses? Paid-in surpluses. This has something to do with the stock, right? Basically, that is the amount that exceeded the initial the face value of the stock issuance. Okay, that's what we call the paid-in surpluses. Now, for example, if you have a stock that is actually issued at the face value of $1, as a matter of fact, you receive $2 per share, right? In that case, then the paid-in surplus would be $1 per share. So that's the additional amount on the equity. Okay, the additional amount of the equity. All right. So what we are saying here is that you have this is what we should actually. There's a par value, just like the stock certificate you actually have seen, right? 40 cents is the par value, so that's the face value of the stock. But as a matter of fact, you collected a lot more than that. Okay, a lot more than that. So therefore, you actually again you have paid-in surpluses, right? Paid-in surpluses. That is the value of the equity. Book value often defines the most conservative value of an oil and gas company. All right, so this is something we said a little earlier, right? By using comparables, okay? So typically, appraised value of O&G companies is often 1.5 to 3 times, okay? 1.5 to 3 times of a book value, okay, book value. And then of course we talked about the company using FC accounting, we have a higher book value relative to appraised value than a company using SE, right? We know that because here we use all this money we invest trying to do that exploration, right? As part of that, the book value, right? Book value of the company, obviously. This I shouldn't say exaggerate, it just states the value that is higher than using the SE method, right? So the SE method actually is a little bit more conservative compared to the FC method. All right. Okay, let's see here. I think this is at the Texaco Chevron merger. Then we have some kind of book values. Okay, we have some of the book values. So if you look at that, the book value is common stock, the par value plus capital in excess of par value plus retained earnings for Texaco, right, is equal to, so the total value, total book value is equal to 14. And here is about 27 at the time. And the number of shares is 567 million and 712 million for Chevron. Right? The book value per share is 525 to 28. So what we are saying here is about 0.66 if you look at the ratio of the stock prices, right? Which means this should be 0.66%, 66% of the Chevron stocks, right? As a matter of fact, when these companies then start to merge and then start to sort of calculate the stock exchange ratios, right? According to, well, actually I have some right here. Yeah, okay. I have that here, right? So basically the ratio is very close to the valuation made at the time of merger when Chevron offered Texaco a stock deal, 0.77 shares of Chevron for each share of Texaco, okay, for each share of Texaco. So basically, Texaco was about 77% of this. So they essentially offered the same amount of stock price, right, at the time of the merger. All right, so the book was, as we said, the book value multiple. Essentially, the market value versus the book value. Here we actually have some of these typical multiples for several sectors, right? The integrated is 2.4, E&P 2.1, equipment service 2.8, and drilling 2, refining 1.2, gas utilities 1.2, electric utilities is about 2. Right? So that's kind of typical. It's kind of typical, even though that changes, right? Probably doesn't change. Or sometimes it depends. For example, like the refining. Okay, the refining. As sometimes later on we're going to look at the valuation of the refineries. This is kind of very interesting because the refineries is not worth a lot of money. Okay, nowadays. Okay, not worth a lot of these things. We can get into the details, right? Compared to their book value and everything. All right, so book value, we should consider the debt into that. So we're going to actually have to have so-called the debt adjusted book multiple, right? So that means then if you have more debt, the company is actually, you have more leverages, right? Leverages. So if you compare to a different company which has a lower degree of a leverage, then you actually have to make that more comparable by adjusting the amount of debt. So what we're going to have here is that you're going to have to use this ratio, okay? Use the ratio. It's not just the stock price divided by the book value, right? So you actually have to put a debt per share into that to control for the kind of leverage that company has, right? So in this case, we'll make an assumption that debt is equal to the total liabilities, right? Total liabilities. Okay, so we have one example about adjusted book value. Okay, adjusted book value. Okay, it's called appraised value, adjusted balance sheet value, okay, or liquidation value, appraised equity value, right? So basically the balance sheet, right, is valued at the standard loan market value. So we'll look at that. I'll look at the example here. The example. Okay, we have actually 500 acres of land. The book value is $2 million. Book value is $2 million. Fair market value is $3 million. $3 million. So the selling cost of 210 All right, so what we're going to do then is we're going to also have the discount, time to sell, right? Assume 12%. So use that discount factor of 0.89. That is 1 over 1 plus the discount factor, right? So the discount factor, 1 plus the discount rate. So we get the discount factor of 0.89. So what is the adjusted balance sheet? So we are looking at the adjusted book value, right? An adjusted book value equals to the 3 minus that selling price, selling cost of 0.21, right? And then at the time, actually it takes time to sell it. So we have discount that amount actually you can receive, right? The amount you receive is 2.79, but that's going to be received at the end of the 1 year according to this calculation, right? So the net worth of that in terms of the book value, adjusted book value, actually it's only equal to $2.48 million, not $3 million, right? So, okay. All right, so the balance sheet, this is actually the correct way of calculating it. We're looking at, of course, the market value of that adjusted. So adjusted book value, the appraised value, adjusted balance sheet, or liquidation value, appraised equity. So essentially, look at the what is the market value of that. So it's not exactly just the book value. So that's why we call it adjusted book value. All right. So basically, adjusted book value. This is more of let's just go through that. I'm not going to ask you guys to actually calculate things like that. But generally speaking, the adjusted book value is equal to total asset minus total liabilities, right? Would be equal to what? Equal to all these items here, right? Working capital, increased value of inventories, right? Appraised value of the oil properties, appraised value of the gas properties, okay? And then add some acreage values of that, right? So you get to add a lot of different things, okay? A lot of different things, right? So this formula actually is not exactly, I didn't do it right. Didn't do it right. That should be, typically it's just like, this should be the one. I probably didn't do it right. Okay, what that says here is that, the working capital equal to total current asset minus total liability, right? Basically, the adjusted book value should be equal to working capital plus all these things, right? So this gives you the impression that it's just equal to the difference of these two, right? Not necessarily, okay? So based on what we should say, we can delete all the top here, just simply say working capital. Right, plus all these other items, adjust for all the other items. Okay. All right. So also have deferred taxes. Okay, deferred taxes. Now we're going to get to the deferred taxes a little bit, all right? Because the deferred taxes can change some of these valuations. Okay, change some of the valuations in certain ways, right? Okay, capitalize the lease obligations, and then all right. So all right. So we are looking at each one of these things. So receivables, we should calculate the value of receivables at the present value. All right. Take consideration of possibility of non-payment, because sometimes you may not be able to get that part back. So you have to take that into consideration to adjust for that. Explain change percentage of the receivables that make up the doubtful portion, and that's just kind of straightforward. Fixed assets, PP&E. Property, that's basically what I meant. PP&E is property, plants, and equipment. That's the fixed asset. Upstream companies have to consider the platforms, power lines, production facilities, and the vessels. Not depreciated value, but there should be appraised that. I don't know, this is just general principle. Okay, general principle. As far as the details are concerned, then we really have to get into that. And at this point here, we really don't need to, but just understand some of the basic principles. And I'm not going to ask you to memorize all that kind of stuff anyway. Okay? But you do have a place to go if that's the case. All right, how about the long-term debt? We have long-term debt, and look at the long-term debt should be the present value of long-term debt. All right, and what's the interest rate used? Now, this is the point we're going to have to look at that. The interest rate used should be similar to the prevailing interest rate, because when you have a debt, the interest payment, right? The coupon rate should not be ever used. Okay, the coupon rate should not be used, right? If the debt is traded in the market, right? You have a market for that debt, right? So if you have corporate debt, for example, right? If you corporate bonds, right? You actually have to trade in the corporate bonds. If that's the case, then we should not use the coupon rate. We should use the prevailing rate of interest, that is the yield to maturity, right? Whatever that rate we should use. Use that to to do that. But even though that seems to be a principle, but it's not the case that every single time, everyone uses the same thing. It doesn't really happen that way sometimes. Okay, so we've got to be careful. Check the interest expense, the average long-term debt. Inventories method use FIFO, LIFO, first in, first out, loss in, loss out. These are for first out. These are some of these methods to calculate the inventory values, right? Underestimate or overestimate, whatever that we don't really have to. Okay. Deferred taxes. I think I have an example of deferred taxes. Okay. I'm going to probably finish this deferred taxes and then and I'm going to stop there. Right. So see the light at the end of the tunnel. Okay. All right, deferred tax. Oh, you know what? I forgot about this part. Thank you. Yeah, it's on the back page, that page. Yeah. All right. Okay, so let's look at the one example here, talking about deferred taxes. Okay, deferred taxes, and there's a little see how deferred taxes can make a difference here. Okay, so this is what we have here. Deferred taxes, right? Due to the accounting treating depreciation, because we know that depreciation will have tax consequences, right? So when you're going to actually have that or not, we're going to have some impact, right? So this is actually, let's just go over that and we can say a few words about that, right? So, okay, financial treatments. Basically, this is what we have here: straight line depreciation, financial treatments. Tax treatment, you have accelerated depreciation. So you have two things here. One is the financial treatment. Then the accounting books that you use this method. And then tax treatment, actually, when you pay taxes, actually, you treat it as accelerated treatment. For example, a lot of times that the government would like to give some of the businesses some kind of favorable treatment. What they could do is allow them to have a accelerated depreciation, okay? In other case, actually, if they want to have, say, I want to have this kind of investment, I encourage this kind of investment. The government would like to say, for example, the pipeline, interstate pipeline, right? We have some kind of under-investment in that particular area, okay? Generally speaking, in the last several years, the investment, the capital expenditure on the pipeline, interstate pipeline, is not enough, right? So the government would like to encourage that. What can you do to encourage that? There are a lot of different ways of doing that, right? One way, of course, is allow for a little bit higher rate of return on the investment, right? This is something you can do. Or you could simply allow the investment companies to have, the pipeline companies to have accelerated depreciation, okay? This actually would give the benefit to the pipeline companies that make that investment. Well, we're going to look at that, all right? So example, assume that the equipment costs $1,000. So let's just go through that example. So what I can explain this example, right? I know it's getting late. All right, so let's look at that. DD&A. All right, we have the revenue is $800 a year for 4 years, each for 4 years. Straight line depreciation, $250, right? Because we have a total amount of 1,000. So the depreciation, straight line depreciation will be $250. And then we have SYD, it's the sum of the year's digit accelerated depreciation for tax purposes, right? So basically this is given here, okay? This is given, which means we have accelerated depreciation. For the first year, you have more depreciation. Second year, lower. Year after that, even lower. So 400, 300, 200, 100, right? So that's accelerated depreciation. So the difference, of course, is 150, right? Look at this here, right? You have 150 difference positive, 150, then you have 50 difference. Then for the third year, that becomes negative 50. Right, negative 50. Here, the last year you have negative 450. All right. So in terms of financial treatment, okay, look at the financial treatment here, and then we have to use this amount here, right? Revenue minus straight line depreciation. Your earnings is 550, 550, 550, 550. That's your earnings according to the financial treatment. Use the straight line. But the tax treatment is a little different. Tax treatment actually uses the amount here, right? Uses this amount, right? Basically, what we are saying here is that, hey, the total amount of tax you have to pay is, on this amount, $400. $400 because you have the depreciation 400 and then the revenue of 800, right? This is 400. And then the tax treatment for second year is 800 revenue minus this depreciation, accelerated depreciation of 300, so you get 500, right? Okay, then 600 and 700. So you pay more each year, basically, on this revenue, which means here you don't pay that much. So you actually have deferred tax. You haven't paid that much of tax, okay? This is what we call deferred tax. You haven't paid that much. You paid it later on for that amount. Okay, so annual deferred tax in this case, by the way, yeah, here. Annual deferred tax is $75. Okay, here. Why $75? Because we assumed 50% tax rate, right? Okay, so here you have $150 depreciation more, right? Okay, so you don't have to pay that much of a tax because you have more depreciation. That's an expense, right? Treat that expense. So you actually do not have to pay that much. So the $75 is a deferred tax. It doesn't mean you will not have to pay. You will pay for it. You will pay that amount of tax. But this is deferred only, right? Okay, it's part of a liability basically, right? You have that. So the balance sheet entry here is the deferred tax on your balance sheet is going to be $75.
I don't understand where that 75 is coming. Is that
75 is the 50% of that $150
So you don't
difference.
have to pay it because it's
Because we are, even though we use the straight line is 250 depreciation, but as a matter of fact, that the tax treatment actually as if you actually have 400 depreciation.
okay. So we're
If the
using-
400 depreciation, which means your revenue in that case, right, is $100 less, right? For example, this is $400 revenue. This is $550. So that just means that you have to pay 50% less on the $150 difference. Tax rate is 50%. Make sense? Okay. So you don't have to pay this much tax. Of course, otherwise you have to pay $75 more tax on that year, right? But now you haven't paid it. Okay. Then for the second year, the deferred tax amount becomes $25 because the difference becomes lower. So your total deferred tax plus previous years now becomes $100 now, right? But the year after that, you have a larger amount you have to pay. You pay $600 on tax on $600 worth of revenue in that case. So you pay more, which means then your deferred tax actually now has been reduced by $25. You pay $25 more, right? You see what I mean? Pay $25. So the total amount of deferred tax now has been reduced from $100 to $75. And then for the last year, you pay extra $75 more than you would have paid if it is a straight line depreciation, right? But then the total amount at the end of the 4-year period is 0, so you don't have any deferred taxes. So what's the total amount of tax you have paid? It's still the same, right? Whether you have this method or this method. But the difference is, when did you pay that tax? You paid in an earlier period or you paid it later on. You see what I mean, right? That difference comes in there. Why? Because using the deferred tax method, using the accelerated depreciation method, you pay more taxes at the end, towards the end. You pay less taxes at the very beginning. Which one is better? Later. You pay taxes later. That is better. Why? Because $75 is not $75 today, the first period, right? The $75 actually is less than $75 here. So basically, you can see that this is a way to shift tax burden, tax liabilities, right? So that gives the firm the benefits of not paying that much of tax. Because if you calculate the net present value of it, right, of this tax payment, discounted, even the nominal value will still be the same from these two methods. But then the actual value you paid, present value of tax you paid, actually is lower under the accelerated depreciation method.
So what happens on a depreciating revenue stream? You can't get rid of everything on that balance sheet entry that shows your deferred tax. Because you're going to be paying less every year. Say you're talking about one well, it's depreciating or it's depleting over time.
Yeah.
The declines.
But if you have all these, right, are you saying that you have multiple, right, that would come in multiple years?
Well, let's say it's the same for the first year, the revenue's 800, but then over the next couple of years, it goes down by 150, so that these.
Which one goes down 150?
The revenue.
You mean like the revenue?
The revenue.
The revenue goes down by 150.
Right, so,
Then this is will change accordingly.
well, yeah, but you've got $75, yeah, right there, and then it goes up to 100, so maybe that would be a little bit less. But then the next one, the 25, that's gonna be even less, and you're not gonna make up. It's not gonna ultimately reduce to zero, there's gonna be some leftover liability there.
But no, well, the thing is that it's not going to matter because what happens then is it's going to be based on the depreciation amount hasn't really changed. You change this here, you're going to see that the total amount you paid will still be the same. The deferred tax, if it's due to this method, nothing else is involved. Okay? If nothing else is involved, you're going to have the same amount. Because the 50% of that deferred tax, I mean the revenue due to the difference in depreciation. This actually is this difference here. Look at that right here. Okay, this has nothing to do with the revenue part. You have more or less revenue. This amount will still be the same because this amount here depends on these two depreciation methods. You see what I mean? Okay, so the revenue amount is not going to really have any impact, right? You guys see the points, right? Okay, see the points? So in that case, then you're going to still at the end of the period, that deferred tax is going to be equal to 0. Right, because of 75, what is the deferred tax here? This amount is.
It would make a difference on the amount of tax you were supposed to pay. Because right there, you're doing 800 minus 200.
Yeah, the tax is going to be different, but the deferred tax will not be. It's not going to change. Yeah, this is not going to change. The amount of tax is going to change, but the deferred tax will not change. Yeah. So, so in that case, then again, this gives the benefit to the company who uses that accelerated depreciation, right? That simply just it just when you pay for the tax, that makes difference. Like this is why 401k is like 401k stuff, right? Of course, 401k stuff you actually have to pay tax later on, and then you also earn interest on interest. That's an added benefit, right? But there's a similar thing. When are you going to pay the tax, basically? Pay it now or pay it later, right? So, before tax investment or after tax investment. So it's a little different. I mean, it's similar, but even though there's a little difference there. Okay. Well, you know what? I'll talk about that next time. So. All right. Pause.